London. And here are your top stories. ASML forecasts better than expected second quarter sales, even as order intakes lag. In the US, we await Morgan Stanley earnings after Goldman Sachs misses out on Wall Street's fixed income trading boom. Netflix pairs double-digit declines post-market after predicting a stronger second half as it cracks down on password sharing. Plus, UK inflation unexpectedly stays above 10%, cementing bets the BOE will hike at its meeting in May. Let's check in on these futures, of course, as investors weigh up both the earnings picture that is evolving and the commentary and the implications for these central banks. The likes of Bullard and Bostic saying higher for longer on rates. Futures pointing lower by 0.3%. And a reminder that when it comes to inflation in the UK, we are still in the double-digit camp. We are not comparable to the Eurozone, a little over 6%, to the US at 5%, because the UK inflation is above 10%, and that sustains and is persisting. The BOE, of course, and the implications for that hike and expectations come May. The FTSE 100 currently down 0.2%, dropping 18 points, 21 points. We'll check in on sterling and gilts in just the next few seconds. The German DAX is down 0.2%. Over in Spain, losses of just 9 points, or just down 0.1%. Yes, we did hear from some Fed speakers. Bostic saying he wants to see plus 5% and held for longer. James Bullard, either not a voting member as well, but also saying that he would like to see potentially the terminal rate getting to 5.75 in the US as they continue to push the agenda around getting inflation back down to that 2% target. Let's have a look at how things are playing out cross-asset with a particular focus on the pound, given that surprise beat in inflation for the month of March. Again, double digits and the pound getting a pop. The last time I checked, up 0.3% versus the US dollar, up about 0.4 versus the euro. We'll get that shortly. Here it comes, 124 on the pound, gaining 0.2% as markets increase their bets on rate hikes from the Bank of England. Futures in the US pointing to a drop of 0.3%. The earnings picture, of course, and the focus on Morgan Stanley. Can they really rub salt in the wounds of Goldman Sachs on the fixed income part of the business? That comes out later today. The 2-year now at 424. Basis point move, 5 in terms of the gains that we're seeing higher on yields. 424 at the front end. And Brent, $84 a barrel. That's a drop of 0.6% on Brent. The inflationary impact, of course, and the China impulse in terms of the demand on oil following that surprise cut from OPEC Plus, all of that playing into the mix. But currently, $84 a barrel. Goldman Sachs have a $95 a barrel target for Brent by the end of the year. Let's check in on those gilts then, again, to see the market reaction in the debt markets to that higher than expected print. Double digits, 10.1% for UK inflation for the month of March. Here's the move then. It is a big move at the front end, 380. That has moved higher by 10, close to 11 basis points. Selling across UK debt. The 5-year at 369, also an 11 basis point move. At the back end, the 10-year, 382. So look at that, 380 on the 2-year, 382 on the 10-year. That is a flat curve, a move of 8 basis points. So the pricing in now of further hikes from the Bank of England, and that is reflecting across the UK debt markets. So we have had UK inflation already this morning. Later at 10 a.m, we're also expecting the final reading for Euro area CPI for March. ECB chief economist Philip Lane speaking to Bloomberg yesterday. He says he believes another rate hike is in order from the ECB.
Q1 suggests we are seeing a reversal of the negative supply shocks that so dominated the European economy last year. So easing of bottlenecks, much lower gas prices. So what I would say from all of that is, as of now, 2 weeks away, I think the baseline is that we should indeed increase interest rates in May.
Okay, that was the chief economist at, of course, the ECB, Philip Lane, speaking to Bloomberg. Let's bring in Emmanuel Cour now, Barclays head of European equity strategy. And Emmanuel, good morning. Thank you for joining us in the studio as ever. Always fantastic to get your thoughts, and particularly on the back of what we've been hearing from the ECB's chief economist as we weigh up and lead up to the inflation prints out of the Eurozone at around 10 a.m. UK time. What is your current assessment and Barclays' current assessment of the rate trajectory of the ECB in a more resilient economy?
I mean, we think there is more to go. We still have high inflation, and to some extent, probably ECB has better reason to hike now because growth has surprised to the upside year to date. The banking stress has been contained as well, and we are left with still very high inflation, right? So we had this data in the UK this morning showing that the battle for inflation against inflation is not finished yet. So, we think central banks for now will keep hiking until they see more evidence of lower inflation down the road. And
the ECB has the stomach to hike into a recession, potentially. Is that your view? Will they continue to go if we get that drop in growth?
Look, I think we are getting close to the point where the mandate to focus on or preserve financial stability, support the economy, and keep inflation low is getting more and more tricky to deliver for central banks. And again, we had some cracks in the financial system a few weeks ago, right? So we are getting to the point where central banks are hurting something. But yeah, inflation is still high, and to some extent growth is resilient at the same time. So I think the resolve of central banks to hike until they see more evidence of inflation coming down is still here.
How do you play that in or fold that in to your view on equities then? And European stocks up about 10% year to date. On an annualized basis, that's plus 30%. It's been a decent rally for European equities despite all of the challenges. Do you lean into that even as you predict further hikes from the ECB?
And look, we think for now there's some support left to the equity market. Firstly, growth is okay, and we just wrote a report on Q1 earnings this morning. We think Q1 earnings will be fine. Of course, investors cannot stop worrying about the outlook because you have more sign of weakening demand and tighter monetary condition. But as of now, earnings are still growing strongly, and that's a backstop to the equity market. And at the same time, positioning is not that high. We've seen investors for most of the past 12 months preparing for recession, moving to cash, turning much more defensive. So to some extent, a resilient or higher equity market is a pen trade and may force more investors to chase. But look, fundamentally, yeah, we don't have much upside left to our target. I see we are leaning on the more positive side of consensus for most of the last 6 months. But our target for the end of the year, our fair value is 2 or 3% away from where we are. And clearly on the 6-month horizon, we struggle to see much more upside to the equity markets. We have reduced risk at the sector level, and we have advice to hedge position as well because vol is very cheap, and now investors are getting paid to be a bit more balanced in their positioning.
So hedge with vol. Your target is 475 year end.
Correct, yeah.
For the European benchmark. You're currently at 467. You're not looking to revise that target higher then?
Look, as it stands, we don't. Clearly, we think earnings won't grow much this year, right? So earnings might not crash, but earnings will probably be flat to slightly down on the year, with a big question mark on 2024 as well. And valuation upside is capped by interest rates. So it's very hard to see fundamentally how you can see a much higher equity market. But again, I think one of the bullish arguments is positioning is bearish. Everybody seems to be on the same view that recession is inevitable. So at the margin, if you were to see better good news on inflation and at the same time growth staying resilient, yeah, you can see more chasing of the equity market. But as of now, we think the bulk of the rebound is behind us.
Okay, so the positioning is bearish. That's one positive potentially for the future for European equities. And then you have what is coming through from China, particularly the strength around the consumer. To what extent do you want to align with European equities with that exposure to China? How much is already priced in to, for example, luxury stocks? Do you look at other companies, other corporates that have that exposure to a reopening and a strengthening Chinese economy?
I mean, we had a very uneven performance on the back of China recovery. So if you look at materials, commodities, miners, they've done very poorly this year, right? So the market is not really playing the usual infrastructure spending boom that we got in the past. You know, market is very much focused on consumer, and yes, luxury good, autos that had a very strong run, and to some extent, you know, a lot seems to be priced in now. Now, we think China will probably keep delivering good data in the second quarter. So as of now, I think there's a bit of juice left in this kind of, you know, maybe European trade. And, you know, from a regional standpoint, we still believe Europe or non-US equities is where you want to be because you have cheaper valuation, but also more favorable growth catalyst with China recovering, but we are getting much more selective in our positioning. We have reduced our exposure to autos, for example, a couple of weeks ago. And, you know, we are a bit more focused on sector which can, you know, benefit from China recovery, but also have ability to shrug off weakening demand and tighter credit condition in Europe and in the US.
It's a big week, of course, in terms of the bank earnings out of the US, and broadly positive. A bit of a mix, of course, around fixed income for Goldman Sachs. We've got Morgan Stanley later today. When it comes to European banks, are you going to see a similar picture evolving where investment banking is looking soft, but net interest margins, deposits are holding up for the big lenders? Is there more space to run for European banks, or is a lot of that positivity priced in?
Well, I think it's a tug of war between what is so far a very supportive earnings picture, right? You know, rising rates are good for earnings, and that's what we've seen with the big banks in the US. At the same time, asset quality is still fine. So, you know, we're not seeing much balance sheet constraint on the banks right now. But of course, given the direction of travel with central banks having to hike more to trim inflation and the risk of more credit accident down the road, I think it's very hard to put banks on a much higher multiple.
Asset quality is a potential concern.
I think this is the issue, right? Down the road, if you think central banks have to push hard on the brake to get inflation down, the question is whether they can do that without hurting more the credit space. And our concern are, you know, that, you know, it's going to be very hard for central banks to really get, you know, inflation under control using higher interest rate as an instrument without ultimately hurting, asset quality.
Okay, Emmanuel Koh, always really fantastic to get your thoughts and your analysis. Really appreciate it. Head of European Equity Strategy with a target there on European stocks of 475. You're currently looking at 467, so further to run after a decent year-to-date start for European stocks. Coming up, ASML posts a beat in its first quarter earnings as demand remains strong for its industry-leading chip-making machines. They have a backlog of orders of around 40 billion euros. We get the latest on the European earnings next. This is Bloomberg.
Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
Welcome back to the Open. We are 14 minutes, almost 14 minutes into the European trading day. Just seeing a drop there of 0.2% across European equities. Futures in the US also lower by 0.3%, weighing up the earnings and commentary from Fed officials. Here in the UK, the FTSE 100 down by 0.3 at 7,882 after a surprisingly strong inflation number for March. Now let's get to your stocks on the move with Joe Easton from our equities team. Joe, what are you focused on this morning?
Right, Tom, so the first one we're looking at is Just Eat Takeaway. This one outperforming in London and Amsterdam. Was up around 4% earlier, now down to around 1%. But they are seeing some better than expected earnings following a deceleration in the last quarter and some positive cash flow as well. Then we've got Glencore up, that one slipping as they potentially go hostile on their bid for Teck Resources over in Canada. A lot of shareholders don't like the fact that they're spending more than $20 billion already on that company. Then Telecom Italia also in M&A news, getting some private equity interest in their networks unit, though some people are disappointed around the prices that's being touted for that one down 3% in Milan. Finally, Bruno Cucinelli benefiting from the quiet luxury trend, not something I know too much about myself, but that is dropping today because some of their guidance is actually quite disappointing. They say there could even be some weakness in the luxury space as the recession progresses. That one is lower today.
Okay, Joe Easton, the purveyor of luxury. Thank you very much indeed, checking in on some of the corporate stocks, or at least stocks on the move this morning. Talking of which, one really interesting story, and important, of course, in terms of the tech space, more earnings around ASML, reporting net sales for the first quarter that beat the average analyst estimate. The company also forecast better than expected second quarter sales amid strong demand, still strong demand for its chip-making machines. For more, let's bring in Bloomberg's April Roach in Amsterdam. April, what stood out to you from these earnings? How positive is it for ASML? Currently, the stock down 3.3%.
Yes, so it seems like a bit of a mixed story from ASML this morning. I mean, as you said from the results, their second quarter sales forecast beat analyst estimates, and they were also able to maintain their financial outlook for the year. They said they still expect sales growth of more than 25% compared to last year. However, orders were down compared to the previous quarter. That's bookings from orders, which, could show signs of some potential market weakness or, indication of what's going on in the chip-making sector at the moment. But overall, regarding their first quarter results, they beat analyst expectations and they have a very strong backlog.
Yeah, it was remarkable to me. It stood out, the number 38 billion, almost 40 billion euros in terms of the order backlog for ASML backlog, of course. Currently, as we mentioned, the stock down a little, pairing some of the heavier losses, currently down 2.9%. April, excellent. Thank you very much for the roundup there. The earnings for ASML, Europe's largest, most valuable tech company. Meanwhile, on to drinks, alcohol, beer. Heineken reporting organic beer volume for the first quarter that missed the average analyst estimate, but the Dutch brewery says it does see signals of a relatively resilient Europe. Let's bring in Bloomberg's Andy Hoffman then for the details. Andy, what was your takeaway then? The key lines coming through from Heineken. Is there any resiliency here? Are they seeing significant softness? What is, in terms of the demand outlook for Heineken, what's it shaping up to be?
Well, there's a couple of surprises here. Yeah. Quite weak in Asia, particularly Vietnam, but Europe looks to be holding up better than expected. Heineken's been raising prices like all brewers in the industry. And Europe was very solid this quarter. And so it looks like the market likes that. And I think it's probably, a somewhat positive outlook here for the industry. Heineken kept its guidance the same. And so, yeah, a positive surprise in Europe.
So as we look to the future quarters, what's going to be key for Heineken? Is it big sporting events? Is it China coming back into play? Is it recession risks around the US?
Indeed, not a lot of exposure to the US, not as much as they'd like. It's all about how demand holds up in Europe, and then if Asia can come back, and if those consumers there can absorb those price hikes and they keep having interest in buying beer.
Yeah, and I wonder if M&A is also a prospect. They're a huge player. They have a lot of market share, of course. Is this also then something within this space, with valuations arguably down or notably, objectively down in the last 12 to 24 months? Is there an opportunity for M&A? Are some of these players lining up cash and looking at potential bids?
There is some speculation that Heineken would be interested in an acquisition in the U.S. They, other than Heineken, they don't have that much presence there. So indeed, this is something that the market is talking about, perhaps expecting, but it is very volatile times, and that it was indeed the word that the CEO used to describe things: uncertain and volatile.
Uncertain and volatile. Nonetheless, the stock currently up 2.3%. Really excellent, Andy. Thank you for the update on Heineken and potentially something to watch around their operations and their ambition, at least, to expand in the US. Coming up, contrasting fortunes on Wall Street as Goldman's fixed income traders lose out, while Bank of America beats estimates. We'll have more on those diverging fortunes next as we look ahead as well to Morgan Stanley. This is Bloomberg.
Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
Welcome back to the Open, 21 minutes into the European trading day. Losses of 0.2%. Top of the list when it comes to European stocks and sectors. Food and beverage just gaining 0.5%. Heineken is part of the mix there. At the bottom of the list in terms of your sectors, real estate down 2%. Futures in the US, S&P E-minis lower by 0.3%. And bear flattening across the yield curve here in the UK, with GEET yields shooting up at the front end at around 380. Now let's get the Bloomberg First Word News with Sam Etienne. Sam.
Morning, Tom. Fox News has agreed to pay over $750 million to settle a defamation lawsuit over its coverage of the 2020 presidential elections. Dominion Voting Systems accused the US TV network of airing bogus claims that it rigged the election against Donald Trump. Fox argued its broadcasts were protected as free speech under the First Amendment. The settlement, about half of what Dominion was seeking, avoids a potentially embarrassing 6-week trial for Fox. And India has overtaken China as the world's most populous nation. According to the UN data, India's population is now more than 1.428 billion, slightly higher than China's. Asia's third largest economy is now home to nearly a fifth of humanity, greater than the entire population of Europe or the Americas. And Netflix says it will start cracking down on password sharing in the US as it looks to boost subscribers following a slow start to the year. The streaming giant added about 1.75 million new customers in the first quarter, missing Wall Street estimates for about 2.4 million. Netflix also announced it's shutting down its DVD delivery operation, ending its original business after a 25-year run. And Sumitomo Mitsui Financial has sold about $1 billion of AT1 debt, becoming the first major global bank to step into the market since the banking crisis erupted last month. The sale is one of the largest deals in the yen corporate bond market so far this year. Another big bank, or rather Japanese bank, Mitsubishi UFJ Financial, is also planning a two-part AT1 bond deal as soon as mid-May. And Apple is racing to build a range of software and services for its upcoming mixed reality headset. The tech giant is seeking to win over potentially wary consumers for its $3,000 headset and its novel 3D interface. Sources say the offerings will include gaming, fitness, and collaboration tools. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne. This is Bloomberg. Tom.
Sam Etienne here in London. Thank you for the roundup of the First Word News. Now, Goldman Sachs traders failed to capitalise on the fixed income bonanza, and it was a bonanza that the rest of Wall Street generated last quarter. That included rival Bank of America, whose own fixed income traders beat estimates in earnings reported yesterday. So it's a diverging picture between Goldman Sachs and its rivals, and not to the upside for GS. For more, let's bring in Bloomberg's Charlie Wells. Charlie, bring us up to speed then on the Q1 earnings from Goldman and Bank of America. Just how bleak is the picture around FIC for Goldman?
It's pretty bleak for Goldman. There's going to be a lot of soul searching. I mean, some of the questions here, when you look at this figure, it was a drop of 17% in fixed income trading. That was lower than estimated, especially considering the fact that this had been such a boon at other Wall Street banks. Was this business mix? What really was this that led to that drop in that business unit? And contrast that with Bank of America. I mean, they saw a surprising increase of 30% in the first quarter when they reported. More good news there as well about net interest income and deposits. So a lot of soul searching after that first quarter report for Goldman.
And Morgan Stanley coming up. They are top of the ticket later today. And are they again just going to kind of grind Goldman's face into the dirt on fixed income? How much of the focus is going to be around fixed income when it comes to Morgan Stanley?
Good question there, Tom. I mean, this is one of Goldman's arch rivals. And strikingly, Morgan Stanley actually focuses a bit less on fixed income trading. They focus more on equities trading. And that could actually be something of a trouble spot. So some estimates from Jefferies put, excuse me, equities trading volume down 7% in the first quarter. So that could actually spell a little bit of trouble. Although Morgan Stanley really has been performing quite well recently. Share price up 6%. When you look at the S&P 500 financials, that's actually been down 3%. So Morgan Stanley, something of an investor favorite.
Okay, so looking ahead to Morgan Stanley, but of course this is an earnings season. When it comes to banks, we're also looking at the small and regional players as well. Western Alliance, what's the picture there?
Really striking. So they reported yesterday, and they saw a share price surge of as much as 20% yesterday. This was on news that their earnings had beat estimates, but also that they had some good news on deposits, more than expected following the banking crisis in March.
Charlie Wells, always excellent. Thank you very much for the roundup of all that banking news. Looking ahead to Morgan Stanley as well. Coming up, UK inflation comes in hotter than expected. We look at what it means for the CPI print, of course, and for the BOE as gilts reprice. That is next. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. ASML forecasts better than expected second quarter sales, even as order intakes lag. In the US, we await Morgan Stanley earnings after Goldman Sachs misses out on Wall Street's fixed income trading boom. Netflix pairs double-digit declines post-market after predicting a stronger second half. That's as it cracks down on password sharing. Plus, UK inflation unexpectedly stays above 10%, cementing bets the Bank of England will hike at its meeting in May. Let's check in on these markets then. After the gains of yesterday across European stocks and, of course, the context of year-to-date gains for European equities of around 10%. And the view from Barclays and Emmanuel Cor early on the show that you're going to get a little bit more upside, but it may not be sustained until the early part of 2024. Across the European benchmark, you're currently seeing a drop of 0.2%. The DAX over in Germany losing 33 points. The FTSE 100 down 19 points. That's a drop of 0.2%. So we're getting central banks speak, but you're getting the data as well, confirming the views of many out there that central banks will have to hike higher and hold for longer, particularly when it comes to the UK on CPI. We'll unpack that story shortly, but you also heard from the ECB's chief economist saying he expects at least another hike from the European Central Bank. James Bullard over at the Fed and Bostic both pointing to higher rates, plus 5%, and being held for longer. The earnings picture, of course, continuing to digest the diverging picture when it comes to the likes of Goldman Sachs and Bank of America. We have Morgan Stanley up next, and here in Europe, of course, ASML coming in with a beat, but investors a little bit cautious in terms of the forward-looking demand for that equipment maker. Let's have a look at how things are playing out across sectors then. At the top of the list, insurance gaining 0.6%, food and beverage helped by a pretty decent picture from Heineken and earnings coming through there, getting 0.5% for that sector. At the bottom of the list, real estate taking a hit, down 2%. We've got a story in the Bloomberg about London house building and house sales continuing to show a decline in this housing market. Technology down 1.5% as yields continue to tick higher. At the front end in the US, 424, that's a move higher by 5 basis points. Let's check in on UK assets then. Inflation double digits, so holding above double digits in the UK. A reminder that you compare that to the US, 5% CPI. In Europe, a little over 6%. Here in UK, plus 10%. in terms of inflation. It's a different picture when it comes to price increases here in the UK, and therefore it rounds out the question for the Bank of England and the market pricing there for potentially another 75 basis points. We're at 425 on the benchmark in the Bank of England rate. Currently, market's starting to price in potentially 5%. May and June now seem to being locked in. And you're seeing a repricing in the gilt markets. Sharp moves higher at the front end. Yields up 12 basis points, 381. This is a bare flattening that you're seeing. The 10-year at 382. And a pop in the pound versus the dollar and the euro. Let's quickly check in on sterling then. Again there, a 0.3% against the US dollar. 124, NatWest, Nomura, HSBC, they have calls on 130 for the pound going forward. We're getting closer to that. For more, let's bring in Vivek Paul, Senior Portfolio Strategist at BlackRock International. Vivek, really great to get you into the studio. Thank you. Let's start with the UK, the inflation print. Your assessment of how concerning this will be for the team at the Bank of England, but also, of course, the UK government has set themselves a target of halving inflation by the end of the year. Is the BOE going to go twice more, 3 times more? How much more work is set for Andrew Bailey and co?
Well, clearly there's still more work to go, right?
Yeah.
So this is still a live issue, 10% the figure that you just talked about. And the fact that that stickiness of that core inflation underpinning it is really tough. There's no getting around that fact. And they are not done yet. And I think it goes to the heart of why this is a different environment from the past. This is a different macro regime. You've got this idea of this persistence of stickiness of inflation driven by supply issues. In the UK, we've got these issues which the government are focusing on, as you've said, but we're not going to get a quick fix, right? People have left the workforce due to long-term sick, due to Brexit. You know, there are a bunch of issues that are not going to be resolved overnight. These pressures are going to persist.
I mean, I'm always getting a sense of a smile from you, Vera, because this underscores the thesis at BlackRock, which is that you're going to get inflation. It's a different regime. It's going to hold for longer. It's going to be stickier. And importantly, central banks are not going to react the same and use the same playbook that they did in the past. And you fold into what we've been hearing from the ECB and the chief economist there, and then the Fed players as well. It seems to be supporting the BlackRock thesis. How do you position around that?
Well, so I think, firstly, when you have this dynamic where central banks are just not going to come to the rescue in the way we thought they would, you've got to rethink.
Swap markets think they will. They're pricing in cuts by July.
Well, and that's where we would take the other side in terms of the US picture in particular. We would see that those rates are going to be sort of above what the market is pricing in when we get a little bit further out. So that's an important distinction. And it then throws into question, what is the portfolio you hold as a result of that, right? The idea of the traditional correlations between equities and bonds. We've seen some element of like a reversal to normal inverted commas in the last few weeks, perhaps, but this is not the time to go back to the old playbook. For us, that sort of traditional way of building portfolios needs to be different. There's a whole bunch of ways in which we need to do things.
You're calling it's the death knell for 60-40.
Yeah, and I think that gets a lot of headlines whenever people talk about 60-40. I think what the point we're making here is that the traditional approach of building portfolios needs to be done in a different way, right? You go back for the last 30 to 40 years, you could hold a static allocation, 60-40, something like that. It was hard to do much better than that. If you held 80-20, if you held 40-60, the annualized return was actually pretty similar because everything rallied. We're now in an environment where that's not going to be the case. We've got more volatility coming. We've got to be more dynamic with those positions. The idea of sort of setting and forgetting a portfolio, turning back to it in 3 years' time, we can't do that anymore. We've got to be more nimble. And also in terms of the building blocks we use, we need to be more granular in terms of thinking about those opportunities here. So the point we're making here, 60-40 is an example of the fact that the old way of doing things we think isn't the case in the future.
There's also a comfort factor, particularly to retail investors. They can leave their portfolios and their pensions in 60-40 and feel relaxed that it's going to do the work for it. But you're saying you're going to have to be a bit more proactive, even at the retail investor level.
I think the point is basically, so I'm not saying that every single investor out there is going to be changing around their portfolio materially, but the idea of just assuming it's going to be the best bet for a long period of time, that needs to be more frequently revisited. That's the point. And I think the point here is that we can do much better than a 60-40 in an environment where effectively we're going to see more macro volatility. There are going to be opportunities that turn up when we see material moves in yields, material moves in equity markets. Take advantage of that. Don't just assume that setting and forgetting is right.
So the here and now, strategically, BlackRock and you guys, you're overweight developed market equities. But you're tactically underweight.
Yes.
Explain.
All right, so the point here basically being is that, over the long run, if you kind of were not sort of a forced seller or had to kind of sort of take your money out in a year's time, we believe that valuations are broadly okay. We'll have seen the worst of the downturn behind us when we're in 5 years' time. That's the point. In the next 6 to 12 months, markets are not yet pricing in the idea that that downturn is going to occur fully in our view. So there's going to be a leg lower before a subsequently leg up, and that's the point, that if you actually are focusing on a longer run horizon, we're more sanguine. We'd start with an overweight to strategic equities, but at the near term, we're a bit more cautious.
Tactically, do you like technology at this point?
Well, I think, more broadly across the developed markets, technology is a sector which will also kind of be affected by a potential raise in rates. Our view, the point we talked about earlier, the idea that the markets are anticipating a rate path which is too low relative to what we anticipate will occur, that's going to be a bit challenging for rate-sensitive sectors, right? So the longer-run environment is much more sort of positive around that, but in the near run, because of that rate dynamic, we'll be a little bit more cautious.
Okay, always smart, Vivek Paul. Appreciate it. Thank you for coming on to the show. Senior Portfolio Strategist at BlackRock International. Coming up, we are joined by Pam Chung, AstraZeneca's Executive Vice President for Global Operations. Stay with us for that interview live from the Bloomberg New Economy Gateway event. That's in Ireland. That's next. This is Bloomberg.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open. We are 41 minutes into the European trading day. Losses of 0.3%. Futures pointing lower in the US by 0.4 on the S&P E-minis. NASDAQ futures down by 0.6%. Just 5 sectors here in Europe in the green, led by insurance gaining 0.6%. Healthcare currently down 0.3, by the way, as a sector. A repricing across UK gilts. We are still here in the UK in the double-digit inflation club. Now, let's cross over to the Bloomberg New Economy Gateway Europe Forum, kicking off today in Ireland. The series brings together regional leaders from the private and public sectors to discuss solutions to the economy's most pressing problems. Bloomberg's Francine Lacroix is at the gathering just outside Dublin, and she is joined by a guest. Good morning, Fran.
Good morning, Tom, and we're delighted to actually get us kicked off in this Gateway New Economy Forum here by Pam Chen from AstraZeneca, where we talk about vaccines, we talk about trade, and of course everything else. Pam, thank you so much for joining us.
Thank you.
And welcome to Ireland. I mean, this is something that's not non-familiar to you because some of your manufacturing is here, but talk to me a little bit about how your industry has changed, not only because of COVID, but supply chain issues.
Excellent. So thank you, Francine. It's great to be here today. I think we can all agree that coming out of COVID-19, the world's in a different place, right? And not to mention, we continue to weather the unprecedented challenges like the war in Ukraine and the geopolitical tensions. So it's a very different place. But I'm a believer that global and open supply chain is critical for the world. Trade, innovation, technology has made us more of a connected, interdependent place, and I don't think that's ever going to go away. So even though we've emerged in a different place, but I do believe this reglobalization topic, reglobalization moving forward will take on a different look and feel, perhaps with a bit of a new rules being played by countries and big players to ensure that we don't stifle innovation and we don't continue to progress forward.
Pam, what does that mean actually for AstraZeneca and for your industry?
Yeah, for our industry, global and open supply chain is absolutely critical. I mean, for a medicine supply chain, it's not unusual to have a starting material for a medicine that comes from specific locations around the world. So imagine stifling that. And the resources, the investment, and the timing that would take to kind of localize a medicine end-to-end supply chain would be, it's nearly impossible, but even if it's possible, would be cost prohibitive and have negative implications for patients and the payers around the world.
Where are we on COVID? So we hardly talk about it anymore. What does it mean for vaccine production, but also the effects on human health?
Right, so this is a perfect example why global supply chain is so important. As you know, we made over 3 billion doses of COVID-19 vaccines supplied to over 180 countries around the world, 2/3 of which are low and middle income countries, and supplying it at cost, at no profit during the pandemic. That would not have been able to be achievable without that global supply chain, right? So being able to leverage that global scale, that capability, resources around the world. We had supply chains from Asia, Latin America, North America, and Europe. So all that collectively together made what we believe to be the impossible possible. So I think that global supply chain needs to absolutely be ensured. Now, in terms of the next steps, we are now working on potential next generations of vaccine, as well as antibody. We also have an antibody for COVID-19 for the immunocompromised patients. So we continue to work on the next generations of that.
And your worries there, is it people wanting to take it, or is it actually development going forward?
It's a development going forward, right? So for the next potential variants, for example, for the next potential implications of the evolutions of the virus.
Pam, you talk about these global supply chains that we need to preserve. Are you worried that actually more countries are inward looking, and so that you have to fight harder to make sure that we don't lose any of that supply chain?
Absolutely. I think it's upon the industry, particularly in the life science industry, for pharma industry, to really have that continued dialogue, right? Those new sets of rules that I talked about, how does countries balance the need to bring back control versus continue to keep the doors open for trade? Because that is going to be absolutely critical, because I personally don't believe localizing pharmaceutical medicine supply chains is a viable or practical thing to do.
Because it'd be more expensive, or because it would take a longer time to put together?
Both, and perhaps more implications than that. So the ultimate implications will be upon the patients and the payers in terms of what it means, right? And you think about thousands of medicines around the world. I mean, patients that need to stay healthy, in some cases to stay alive. So imagine being unable to get that when the patient needs it. So I really do believe that continued dialogue is extra critical on how we need to leverage that global openness around the supply chains.
The Inflation Reduction Act in the U.S. really touches almost everything. What does that mean for research and development in your industry?
Yeah, and I think I'm pretty optimistic that both sides around the Atlantic is going to be able to find sort of a common space and over the aspects of the Inflation Reduction Act. I think I'm happy to see the Europeans respond with the Green Deal industrial plan. I think ultimately, if you look at climate crisis, I mean, that's the biggest crisis in the 21st century. Yeah. Nearly 14 million people die every year due to environmental health risk, and including 7 million die from air pollution alone.
But because of the incentives in the U.S., will you do more in the U.S.? And also, you've chosen Ireland over the U.K. in terms of investments. Like, how do you choose where you put money?
So we are a significant company with a significant pipeline. So we've got significant levels of investment. So we don't sort of, it's not either or, right. It's and in a lot of cases, right? So with the significant investments we do, now particularly with Ireland, I mean, when we look at be it manufacturing or R&D, we look at the overall environment, right? The friendliness of the operating environment, the incentives, and more importantly, that incentives for innovation, for science, for technology, and the ability to drive our climate agenda as well. So I think if you look at Ireland, it's an ideal place to operate, right? It's no stranger to the pharmaceutical industry. And that we are part of it, and we will continue to make sure that this becomes a strategic footprint for AstraZeneca.
Pam, thank you so much for joining us. Pam Chang there from AstraZeneca. With that, Tom, I'm going to send it back to you in London, and we'll have plenty more interviews throughout the day here in Ireland, close to Dublin, for the New Economy Forum Gateway.
Okay, Francine Lacroix, thank you, of course, at the Bloomberg New Economy Gateway Europe Forum in Ireland. And we're going to be speaking to more big-name guests from the event throughout the day, including Andrea Orcel, UniCredit's CEO, and Willie Walsh, the Director General of IATA. Stay with us for that. Let's get the Bloomberg First Word News now with Sam Etienne. Sam.
Morning, Tom. Fox News has agreed to pay over $750 million to settle a defamation lawsuit over its coverage of the 2020 presidential elections. Dominion Voting Systems accused the US TV network of airing bogus claims that it rigged the election against Donald Trump. Fox argued its broadcasts were protected as free speech under the First Amendment. The settlement, about half of what Dominion was seeking, avoids a potentially embarrassing 6-week trial for Fox. And a 24-hour ceasefire between Sudan's military and a rival faction group appeared to be only partially observed in the capital, Khartoum. Fighting raged between the groups on the 4th day yesterday, suggesting the deadly conflict for control of the North African country is far from over. The battles have left more than 180 people dead and at least 1,800 others injured. And a previously unreported assessment of Russia's government says senior officials raised concerns last year about becoming too dependent on Chinese technology. European officials who've seen the report say it highlights chips, network devices, and electronics as areas of particular vulnerability. Moscow has struggled to produce advanced technology domestically and has been cut off from other markets by sanctions. And French President Emmanuel Macron is seeking China's help to bring Russia and Ukraine to the negotiating table. Bloomberg has learned that Macron has instructed his foreign policy advisor to work with China's top diplomat to establish a framework for future negotiations. Sources say the French president seeks talks happening, or rather sees them happening, as soon as the middle of the year, if all goes well. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Tom.
Sam, thank you. Coming up, Netflix says it is expecting growth in the second half of the year as it cracks down on password sharing. We'll get more on the company's earnings next. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Welcome back to the Open. 53 minutes into your European trading day this Wednesday morning. Gains, losses, I should say, of 0.2% across European stocks. Futures in the US also pointing lower by 0.4%, and a significant re-rating in terms of the expectations from the Bank of England, given that inflation here in the UK remains stubbornly in double-digit territory. Yields jumping across the UK gilt debt curve by 12 basis points. At the front end. Let's get to the corporate earnings story then. Of course, a massive week for earnings. Netflix reporting lower than expected subscriber gains for the first quarter, but the streaming giant says it's expecting growth in the second half of the year as it cracks the whip on password sharing. For more, we are joined by Alex Webb of Bloomberg Quick Take. Alex, to what extent can we be confident that they're actually going to turn things around in terms of subscribers, in terms of growth with this crackdown on passwords in the months and quarters ahead?
Well, they've predicted some fairly bullish numbers in terms of free cash flow for the second half of the year. The previous outlook had been for $3 billion. Now it's $3.5 billion. That's also above where the market saw it going. So the company itself is clearly pretty optimistic. It says there are about 100 million people who share passwords. If they crack down on that, they would clearly then anticipate at least some of those to translate into subscribers. The key question is going to be what percentage? Is it going to be 5%? Is it going to be 50%? A lot of suspicion is it's going to be more towards the lower end. But given some of the issues they've had with stagnating subscriber growth in recent years, in the first quarter, they added 1.75 million subscribers. The estimate was for 2.4 million. Even if you add 5%, that could still be, quite a sizable difference given the performance in recent years.
And Alex, we've had some updates in terms of the job cuts coming through, the axe falling at Disney and Meta as well.
Yeah, so we've had a little bit more clarity on what Disney is up to. They plan to start, cut thousands of jobs next week, including, interestingly, about 15% of staff in the entertainment division. Those are the people who make the films and TV shows, not just for cinema, but also for Disney Plus and parts of its broadcast division. So it's not going to be the only division that's affected. There will be cuts across, all of them, but the 15% is quite a meaningful number for that core business. Meta also is going to be cutting jobs. We know the numbers, 10,000 further jobs, but it is going to be across Facebook, WhatsApp, and Instagram. Some expectation may be that Instagram, WhatsApp might not be as heavily affected given the expectations that they would be driving growth. They are not going to be untouched.
Okay, yeah, a difficult time for tech workers in Silicon Valley, particularly as we got more details, as you say, of the job losses coming through. Alex Webb, really appreciate it, of Bloomberg Quick Take, running us through the big tech stories at the moment. Let's check in the markets before we let you go. Across the equities, again, you're seeing losses of 0.2%. Really, the interest, particularly in the UK, is focused on what is happening in these gilt markets. The pound has jumped and gilts are selling off. Yields up 11 basis points at the front end, 380 as markets start to price in a hike both in May and June for the Bank of England as inflation remains stubbornly in double-digit territory. Futures in the US lower by 0.3. Surveillance early edition up next. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Connection lost.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. ASML forecasts better than expected second quarter sales, even as order intake lags. In the US, we await Morgan Stanley earnings after Goldman Sachs misses out on Wall Street's fixed income trading boom. UK inflation unexpectedly stays above 10%, cementing bets the Bank of England will hike at its meeting in May. Plus, the chief executive of UniCredit, Andrea Ocel, joins us in conversation at the New Economy Gateway, Europe. Let's check in on these markets then. You're lower across European equities is way up the earnings front, but also the commentary from Fed officials and the data coming through from the UK on the pain of inflation. European stocks down 0.2%. James Bullard saying he wants to see potentially 5.75 in terms of the terminal rate from the Fed. You're currently at the top end at 5% on Fed rates. 5.75 as the market priced for rates at that level. That is a question maybe being posed across these markets. Futures in the US now down by 0.3%. We continue, of course, to focus on the bank earnings with Morgan Stanley coming up later today. And we're going to unpack that story in more detail for you. The US 2-year, 4.25, yields moving higher, and that's having an impact across the technology sector. 5 basis point move higher at the front end, 4.25. It's even more aggressive when it comes to UK gilts. And again, we'll touch on those just in the next couple of seconds. Brent at $83 a barrel, falling 1%. This will be tied, no doubt, to concerns about recession risks as inflation remains stickier. And central bank officials from the ECB to the Fed really cement views that hikes are going to have to come through higher and possibly for longer as well. Let's check in on those UK assets then, because you had a big move in terms of the pound versus US dollar and euro, but also, of course, repricing around expectations of further hikes from the Bank of England. Let's remind ourselves, we're in a different category now here in the UK. We remain in the double-digit camp. It's not the same picture in the Eurozone. It's not the same in the US, where CPI is at 5%. We are the outlier here in the UK, and we're having to reprice what has already been an aggressive response of the Bank of England. Expectations that you get hikes now from May and June. We're at 4.25 now. Market's starting to price in 5% as the top end from the Bank of England. There's the move in the gilts. Bear flattening from the 2s to 10s, yields higher by 12 basis points at the front end, 381. The 10-year, 382. Let's check in pre-market. Of course, a big week for earnings. Netflix coming in with subs that disappointed to the downside. Subscriptions came in lower than expected, but then pricing started to change on the update and the outlook. So you saw a 12% drop pre-market, This is the pre-market move now, down 0.6%. Again, on the outlook, looking a little bit more positive. A lot of that is going to be contingent on their hopes that the password crackdown is going to pay dividends in terms of getting more people on to this streaming platform. So that's the Netflix right now, pre-market down 0.6%, really pairing significantly the heavier drop that we saw immediately after those results. Let's get to banking though. Goldman Sachs traders failing to capitalize on the fixed income bonanza that the rest of Wall Street generated last quarter. Question marks arguably for the CEO. That included rival Bank of America, whose fixed income traders beat pretty healthily the estimates in their first quarter earnings. Let's bring in Charlie Wells, who's been across all of the details when it comes to banking. Charlie, set the scene in terms of Goldman Sachs and the challenges around fixed income, particularly when it comes to their rivals.
Yeah, this is really difficult. It's been one of the most dramatic and perhaps surprising earnings seasons for Wall Street banks in a long time now. You saw this surprise with Goldman Sachs. You know, fixed income trading revenue for the first quarter down 17%. That makes them the only large Wall Street bank to have reported so far a drop in that division. So contrast that with Bank of America. There was another surprise, but it was a surprise on the upside, a 30% growth there in that fixed income trading division. So that is very good news for the CEO of Bank of America. More good news on net interest income as well as deposits. So this earnings season has certainly posed a lot of unexpected changes following that drama that we saw in March with U.S. banks.
It's just worth pausing on that, isn't it? 30% increase for fixed income for Bank of America versus a contraction of 17% for Goldman Sachs. Morgan Stanley coming through later. Are they going to fall in the Goldman category or the Bank of America category?
So Goldman's not going to like us. I mean, Morgan Stanley has been performing very well in the markets this year. Their share price is up 6%. When you look at the S&P 500 Financials Index, it's down 3%. So Morgan Stanley in good standing with investors right there. You know, one of the differences here, though, is Morgan Stanley focuses more on equities trading as opposed to fixed income. So that may not bode quite so well. We know from some Jefferies data that trading in equities for the industry at large has been down 7%. So potentially not as much of a boost there, but I'm really focused on wealth management. That is something that really has made Morgan Stanley a darling of investors. They've really been able to pivot to that over the years, get that fee income coming in, that revenue coming in when markets are good and when markets are bad. That could provide a boost.
They were ahead of the curve, well ahead of the curve. The likes of Credit Suisse rushing to build out there, but the likes of Morgan Stanley well ahead of the curve in terms of building out that asset management, wealth management part of the business. We don't normally care about regional banks in the US, frankly, but given what's happened in the last few months, we do this time. Can we take any reassurance from what's happening at Western Alliance?
You know, we really can. So we saw as much as 20% of an increase in the share price yesterday for Western Alliance. That is a Phoenix-based bank, which we don't necessarily focus on here from London, but these banks were really at the center of that March madness last month when there were concerns about deposits. Deposits came into focus yesterday with Western Alliance, saying that they had actually seen an increase from the end of that turmoil, March 20th, to April 14th, so just last week, they saw an inflow of $3 billion. So that is reassuring, and that was reassuring for the markets yesterday for their share price.
They're obviously doing something right, aren't they, to reassure their clients. Really appreciate it. Charlie Wells, of course, with a preview of Morgan Stanley, and of course, the resilience that we're seeing, at least for now, across some of those regional lenders. Tensions, of course, in the financial sector, supply bottlenecks and energy prices, well, they have all eased, but a more detailed picture of inflation is needed. That is the view of the ECB chief economist, Philip Lane, who sees another rate hike in May. He spoke to us at the Bloomberg New Economy Gateway Europe Conference in Wicklow in Ireland.
Q1 suggests we are seeing a reversal of the negative supply shocks that so dominated the European economy last year. So easing of bottlenecks, much lower gas prices. So what I would say from all of that is, as of now, 2 weeks away, I think the baseline is that we should indeed increase interest rates in May.
Okay, the ECB's chief economist, Philip Lane, on the expectation that you will get another rate hike from the ECB at the next meeting, at a time, of course, when markets are now pricing in, when it comes to the Bank of England, another hike, not just in May, but also in June as well, with the terminal rate at 5%. We're currently at 4.25 on the Bank of England rate, on, of course, the moves and the need to address that double-digit inflation. Let's cross over now to Leanne Gehrens with the First Word News. Leanne.
Tom, good morning. Fox News has agreed to pay over $750 million to settle a defamation lawsuit over its coverage of the 2020 presidential elections. Dominion Voting Systems accused the US TV network of airing bogus claims that it rigged the election against Donald Trump. Fox argued its broadcasters were protected as free speech under the First Amendment. The settlement, about half of what Dominion was actually seeking, avoids a potentially embarrassing 6-week trial for Fox. India has overtaken China as the world's most populous nation. According to UN data, India's population is now more than 1.428 billion, slightly higher than China's. Asia's third largest economy is now home to nearly a fifth of humanity, greater than the entire population of Europe or the Americas. Netflix says it will start cracking down on password sharing over in the US as it looks to boost subscribers. Following a slow start to the year, the streaming giant added only 1.75 million new customers in the first quarter, missing Wall Street estimates for about 2.4 million. Netflix also announced it is shutting down its DVD delivery operation, ending its original business after a 25-year run. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Tom.
Leanne, yeah, that's the headline for me, that they're closing down the DVD business. I didn't know they were still in it. I knew that's the way they originated, of course, but 25 years later, there they go. They had a DVD business up until about yesterday. Okay, let's cross over now to what is happening in Ireland. Bloomberg hosting its inaugural New Economy Gateway Europe conference near Dublin, on the outskirts of the capital. Bloomberg's Francine Lacqua joins us live from the forum in Ireland. Francine.
Yeah, good morning, Tom. We're quite excited to be here in Dublin. This is the first Bloomberg New Economy Gateway. Now, we usually host this conference in Singapore. This time, we're deciding to focus, of course, on trade. We also have a great conversation on banking, not only what some of the Swiss banking turmoil means for European banking, but how they can still service their clients across the board. Now, very shortly, Eric Schatzker, the editor-at-large for this conference, will also speak to Andrea Orcel. He's the chief executive officer of UniCredit, one of the largest banks, not only in Italy, in Europe, but if you remember, he was also number 2 at UBS. It'll be interesting to have any thoughts that he has on the merger between UBS and Credit Suisse. And a little bit later on, we also focus on the airlines. I'm very much looking forward to hearing from Michael O'Leary, the Chief Executive Officer of Ryanair, to see not only what he thinks foreign direct investment looks like getting into Ireland on the back of the US president showing up here last week, but then we'll also hear from Willie Walsh, who's former BA Chief Executive. Tom.
Okay, but the Ryanair CEO, he's so quiet and meek. Yeah, let's brace ourselves. It's often firing, isn't it?
Absolutely.
Fiery, of course, with the head of Ryan. That's going to be a lot of fun.
Last time.
What else? No, carry on, Fran.
Tom. Yeah, so last time we spoke to him, he said that he surprised all the passengers by being at the gate and checking them in. So I can't wait to see how he arrived, back in Ireland and who he was checking in this time. I mean, it's never dull. And I know he's doing a conversation on Brexit. He never, ever holds back from talking about Brexit or anything political. So it'll be interesting to know what he says about that.
Yeah, that is going to be a really gripping conversation, isn't it? And you've also been talking healthcare, supply chains, post-pandemic, what's happening with the vaccine makers. What else has kind of really stood out to you as we just kind of start and edge into the beginning of this event?
Well, when you look at global supply chains, and we had a good conversation with one of the vice presidents at AstraZeneca, Pang Chen, she says she's worried, certainly in her field, which is healthcare and biopharma, that as geopolitics gets more fraught, as we have a lot of domestic input to try and get some of the supply chains back home, that actually all of this globalization ruptures. Now, what this means for the production of vaccines, but also how you ship vaccines across the world, could have huge implications for her industry. Now, it was interesting also to get her thoughts on the Inflation Reduction Act. And I know we'll spend a bit of time here speaking to big chief executives of financial firms about not only the debt ceiling in the US and what that means for markets and what that could be the implication longer term, but the Inflation Reduction Act. So this is, for example, Ireland. If you look at how much foreign direct investment they've attracted, $9 billion last year, 70% of that is from U.S. investors. Does that money go back to the U.S. instead of coming to Europe because of the Inflation Reduction Act? Again, they're trying to do everything when it comes to help with climate change, research and development and the like. So these are just some of the good conversations that we're hoping to have here in Ireland.
Okay, excellent stuff. Lots, of course, to work through in terms of the big topics of the day. Francine Lacroix on the ground for us, of course, just outside of Dublin. We'll be crossing back to Fran just in the next couple of minutes. Let's get a pre-market check on Tesla, because guess what? As forecast, they have cut prices again, second time this year in the US. In terms of the models, we're talking the Model 3 and the Model Y. And this, again, a reminder that this is a company that is prepared to sacrifice its margins on the altar of market share. Pre-market, Tesla down 1.6%. So just as an example, on the Model Y, again, this is stateside, you're looking at a drop in terms of prices of 5.6% to just below $50,000 US. Again, the margin's going to be squeezed and hit on the back of this, but it's about maintaining and expanding market share. And this is driving a lot of pressure across the auto space, others having to respond with their own price cuts. We'll keep across this story for you. Of course, currently down 1.6% pre-market. Let's check back in on Netflix as well. Originally and initially, after the results came out, you saw a drop of about 12%. And then you had the commentary from the executives where they really laid out a scenario where things will improve. The expectation, of course, for Netflix as they crack down on password sharing. They think there's about 100 million people who do not pay for access to the service as they crack down across the various different jurisdictions. They think they're going to get those subs back up. And then you saw that big pairing of the drop. You're currently down about 1.1% on Netflix. But again, the context is you saw a sharp drop of 12% straight after the results. A little bit of comfort coming through in terms of the forward guidance then on Netflix. Just checking in on two of the big corporate stories. Morgan Stanley, of course, on the banking front is up later today. Really interesting, particularly to focus in on the fixed income part of that business after the disappointment of Goldman Sachs. Meanwhile, on Netflix, reporting, as I said, lower than expected subscriber gains for the first quarter. The streaming giant says it is expecting growth in the second half of the year, again, as it cracks down on password sharing. Some tech analysts, they say the company should stop focusing on sub numbers. Take a listen.
But if we start to see them continuing to grow on a revenue basis, and again, advertising becomes an important revenue. As soon as you add advertising in the mix, I think you have to drop just subscriptions because it's going to change the overall picture from a revenue perspective for them. So yeah, I mean, people are still going to look at it for the next couple of quarters, I think. But over time, I say by this time next year, for sure, it's going to be a revenue-only story.
I think I'd be more interested in profitability and the fact that we're in a year where we're comparing against still some COVID impact in different parts of the world. I would say that we need to stop focusing on the subscription growth and really focus on, as I said, free cash flow growth.
All right, some commentary there on those Netflix earnings. Let's listen in now and cross back to what's happening in Dublin. Discussions at the New Economy Gateway, just outside the Irish capital. Bloomberg's Eric Schatzker is speaking to UniCredit Group CEO Andrea Orcel at the forum in a moment. We will be crossing over. You can see Eric Schatzker there on stage. Important in terms of the conversations coming up around the banking space, of course, in Europe. We're going to be speaking and hearing from the CEO of the Italian lender UniCredit. In terms of the banking stress, credit conditions, of course, the loan requirements, and to what extent asset quality is holding up in this environment. It's worth checking in on the markets at this point, because to point out that European stocks are down 0.4% is really missing the story of the moment, which is repricing in UK assets on the back of double-digit inflation. You can tie the inflation story, of course, to what's happening in the banking space. But briefly, let's check in on gilts then. You're looking at a move significantly high in terms of yields at the front end, 12 basis points at the front end, the 2-year, 381, at the back end, 382. So look at that bear flattening then. 2-year at 381, 10-year at 382. The pound, we'll have a look there as well. There was a pop versus the euro, versus the US dollar. Again, double-digit inflation remains the story in the UK. It's not the story in the US. It's not the story in the Eurozone. It is the story here, though. There are political consequences of this, and there is, of course, the response from the Bank of England as markets now price in rate hikes, not just in May, but also in June, A reminder that the rate here from the Bank of England is currently at 4.25. Markets now expecting you're going to get to 5%. How much damage does that bring to bear on the UK economy? And what does it mean politically as well for the government of Rishi Sunak? There's the pound then, 124, gaining 0.2%. NatWest, HSBC, they have a target, 130. We're moving in that direction. Let's cross back to Francine Lacroix on the ground, just outside of Dublin, ahead of this panel. Francine.
Yeah, Tom, I'm looking forward actually to hearing Eric Schatzker in conversation with Andrea Rochelle. This will be the first time that we hear from Andrea Rochelle since the banking crisis, actually in a public forum. So I think some of the things that Eric will try and get out of him is, first of all, how he lived through the month of March. So you're a global chief executive, but based in Italy, which means that you're much closer to the banking crisis in Switzerland. So what did it feel like when SVB went down that Friday night? Was he really trying to follow what was happening in the US in terms of deposit guarantees, because that has a huge read across for the European banks? It'll be really interesting to also see whether the fact that now Switzerland has only one major bank, with essentially cutting off some of the other investment banks, whether it still means that Europe, and I know this was previously, certainly when he was at UBS, one of his big dreams, that Europe would have an investment bank strong enough to rival some of the Wall Street titans. So if you look at the context, you have JP Morgan, really some pretty incredible results. You have the same for Bank of America, Morgan Stanley doing really well. With the consolidation now of Credit Suisse and UBS, where does it leave European banking? Do we need a national champion, regional national champion, to try and service some of the clients so that it takes a bit of market share from the US? So I think they'll focus on that, and then just in general, where he sees interest rates and what that means for his business model and deposits. We saw, and Tom, we were talking about this on air yesterday, the fact that Apple with Goldman Sachs has this new deal where actually you get 4.15% on your deposits. How does that change all of the European banks?
Really, really interesting point. Let's listen in now to those discussions and hear from the CEO, of course, of UniCredit, Eric Schatzker, speaking to UniCredit Group's CEO, Andrea Rochelle. Let's see if he put some of those questions that Fran flagged to the chief executive. Let's listen in to the forum, Bloomberg New Economy Forum, just outside of Dublin.
Andrea, it is awfully good to see you here.
Thank you, Eric. Very nice to be here.
I'm going to remind you that just 6 weeks ago, it seemed like the world was barreling headlong into another banking crisis. There was a real sense of panic. There was a historic flight to safety in the Treasury market. I want to know, what was it like running a bank and worrying if this wasn't 2008 all over again?
Well, I think that obviously when you see shocks like this one, and not one, but more than one, at the same time, you question whether you're missing anything. And then you review everything that you're doing and you're saying, well, can it happen to me and what's different? I think that the conclusion is that these were isolated cases. They were pretty much idiosyncratic. They highlighted that regulation, in my opinion, needs to be applied consistently across not only banks of various sizes, but also all financial intermediaries. And that you do not need to stop at rules, but also look at the principles that are backing those rules and seeing whether institutions are managed in the way they should be managed. That is the key question at the end of the day. Today, we risk to have a knee-jerk reaction and add more rules, more tightening, when the banks, especially the Europeans, who have been submitted to those rules, actually do not have those problems because those rules have worked.
Silicon Valley Bank failed on a Thursday night. Within a couple of days, Credit Suisse had been forced into a shotgun marriage with UBS. How long after that, and of course Signature Bank also failed that Sunday night back in New York, how long did it take before you felt like everything's going to be okay?
Well, I think there is a general question that any times you dent trust and confidence into the system, then you worry. Because at the end of the day, banks are built on the trust and confidence. So that for me was the key issue. Is the broader market not understanding exactly what triggered the situation going to say we have another 2008 and therefore all the banks have the same issues? And the market reaction was exactly in that direction. But when you look at the issues that triggered that, at least for example in the US, liquidity, interest rate, mismatches, and we just could not be doing that even if we wanted to, and we do not want in Europe. So it does not apply. What applies is a read across that affects confidence. So let's say that we were convinced that we were in a solid position quite quickly. What we were worried about is the contagion by the lack of trust, of confidence. I think that the ECB just keeping its direction with rate increases.
Not blinking.
Authorizing us to distribute 3.35 billion of share buyback to our shareholders. That's about 10% of our market cap. Kind of underscored with facts that the situations are very different.
Today, with a couple of notable exceptions in the US, it almost feels like nothing happened last month. Is the storm really over, or might there be more to come?
Well, I do think it's more a question of, and we discussed it recently, notwithstanding what we think about globalization or deglobalization or reglobalization, I think we are substantially changing the rules that have held for all of our economies and our politics for the last 50 years. And you're having a redefinition of value chain, a redefinition of political weights, a redefinition of friends and foes, interest rates that for Europe have not been positive for 15 years and now are positive, energy prices that are changing, structural inflation in the system. It's just not credible that we're not going to have uncertainty, and shock. So I think what has changed is you manage for a central scenario, and at the moment we all feel, okay, we're back to the central scenario, but you need to anticipate that you're going to get deviated by one issue or another, and as long as you are prepared for that and you react quickly, hopefully you're going to be okay.
Bank regulators in the United States and in Switzerland swooped in with backstop funding to keep the crisis contained. It happened with the Swiss government, Swiss National Bank. It happened with the Fed and the FDIC. We've learned over the past 15 years that government action has unintended consequences. Should we be worried about the unintended consequences of this government action?
Well, I think that when you have a bank of size and confidence goes away, the first thing to go is liquidity. Actually, we all focus on capital, but what gets a bank to go is liquidity. It's people wanting their cash back now. And so for a government to backstop that and saying that's not going to be an issue is the right thing to do. Can there be consequences? Well, it depends. I think you do that, you backstop, but the moment confidence and trust comes back, you need to pull back, because otherwise you support all the time and you create asymmetry in the market. But I do think it was what was necessary to be done. I think the more general question for all of us is not only a reminder that banks as organizations that fulfill a role have risks, and you cannot eliminate risks altogether. I read a lot of times, oh, we need to eliminate all the risk of a bank. You cannot. If you eliminate all the risk for a bank, banks do not fulfill the role that they should be fulfilling, and you're transferring those risks somewhere else. And I do think that what we need to ask ourselves is, and especially in Europe, what do we want the banking system to do? And then, based on that, what rules and regulations and what guidance do we need to do to run the banks? And I don't think we do enough of that. We do a lot more of what additional rules do I need to do to eliminate the risk, rather than if a bank needs to do X, Y, Z to support the economy, etc., what are the necessary rules and regulation to support that role, but to make it done, to ensure it is done in the right way.
Since you've mentioned more than once the importance of trust and the risks of losing liquidity in the system, I want to ask you this. It appears that one of the obvious lessons of the failure, in particular of Silicon Valley Bank, is that today, in our digitized world, deposits can vanish instantaneously. Nobody needs to stand in line, right, to withdraw cash. All it takes is a few clicks on your smartphone. As a bank CEO, do you have to think differently about deposits now?
Well, I think we have been thinking differently about deposit and funding for a while. But what I think happens, and especially in Europe, is that the structure of the market is different. When you have this situation, people are reminded that banks are not all the same, that they're a strong bank and less strong bank. And therefore you have a flow of deposit, a flow of liquidity towards the quality of the stronger banks, away from the weaker banks. Until you have those shocks, people just pursue convenience and they pursue pricing. The moment you have a shock, you say, well, hang on a second. What I want is preserve capital and have the certainty I'm going to see it back. And therefore, there's a flight to quality, and we're seeing it every day. And then it depends with the development of your client base. So depending on where we are between Bulgaria, Romania, Italy, Germany, behaviors of clients and of families and of corporates, very different. Some people are still very much attached to branch, to local relationships, and deposits are seen in a very different way to other people who probably are a lot more digitalized. If I look at the use of digital channels in Lombardia in Italy, and I compare it to other regions of Italy, in Lombardia we have 6% of branches and 11% of deposits. I do that same thing in Sicily, and I have a completely different ratio. So I do think it's not one size fits all, and among our market, we just need to follow the consumer or the client and serve them the way they want to be served.
So you're right, of course, that there is a movement of deposits from people, from institutions people perceive to be weaker to institutions that people perceive to be stronger. It's happening here. It's also happening in the United States. That has consequences, doesn't it? I mean, if you lose your funding base and you cannot adjust your assets quickly enough, you've got a problem.
Well, you do, but
and then regulators are going to have a problem.
You do, but in practice, there is always a question of what is your structure of your asset and liabilities? What is your interest rate risk? For example, at UniCredit,
I'm not saying you have a problem.
No, but what I'm saying, at UniCredit, first of all, there are limitations on the BAL on what we can do with interest rate risk. And secondly, at UniCredit, we swap everything. Everything is floating. So
in other words, what
I
SVB
don't run
did not
that
do.
mismatch. I don't run that mismatch. So that is penalizing in period of low interest rates because I don't get the benefit on my interest margin of that mismatch. But by being conservative, when you have a shock like that, I don't feel it. I don't have the same element of issues. That's why I'm saying rules, but also what is the spirit of regulation? Is the bank run in a way that if you get shocked, you can absorb the risk that you're taking? And I think we need to step back sometimes because the mere application of rules is not enough.
Andrea, my editor-in-chief, John Micklethwaite, has argued that the latest round of bank bailouts signals a new era of what the French will call dirigisme, the state control of finance. And if Europe wants a real banking union, it has to consider cross-border mergers to create continental champions. Is he right?
I think we talk a lot about banking union, we talk a lot about capital market union, and we talk a lot about cross-border M&A. I think the bigger question is...
None of those three has happened.
Well, because the bigger question is, and you were saying something about that in your opening remark, is what does the European Union want to be? What does Europe want to be? Because either we want to pursue that convergence that we started with the project. We have a clear ambition to delegate some of our sovereignty of each state to the center and create an economic bloc that can be as strong as the US and China. And I do think that globally, there will be a benefit for having a third economic bloc that can stand. And at the same time, for the Western world, it's a very good thing to have. Or we're going to continue to say that we're all different and to say that we have a European Union, but with so many exceptions and so many limitations. But then when you ask me, banking union, I'm sorry, if we're all fragmented, union of what? Capital market union. If we're fragmented, capital market union of what? Cross-border M&A. If I don't have free flowing of capital, liquidity, clients, because I don't have a real united market, what are the synergies and the benefit to do a cross-border acquisition? So I do think that the key question is, do we want to, post-Brexit, post this shock, review what Europe should be and converge to that? Then the banking union and all the objection that we have will go away because we are converging to that. Or we want to remain as we are, saying we are a federation, but not being one, and then say, oh, but I want the banking union as well. It's never going to work.
So just let's get this straight. You are asking what to me sounds like a rhetorical question. If Europe really wants to be on equal footing with the US or the North American market and China and its sphere of influence, it can't just be a monetary union. It has to be a fiscal union. It has to be a banking union,
well,
a capital markets union.
It definitely has to go a lot further. I think if you look at European population, education, innovation, GDP, potential, it has all the ingredients to be on par or in the middle with those economic blocs. We never are. In a way, and in a very small way, it's a macrocosm of what UniCredit is. 13 bank, 13 market, large fragmentation, large complexity. You either bring it to common denominator or all you have is fragmentation and complexity.
So what role does UniCredit play? Do you become a consolidator in this unified market that you dream of?
My predecessor believed in a united Europe and built UniCredit. With the benefit of hindsight, if you asked any research analyst, they would tell you it doesn't work because it's complex and fragmented. So in our mission statement, we want to be the bank for Europe because we are highly dependent on Europe. We want to see a winning Europe because that would create an immense opportunity for UniCredit. But UniCredit cannot become a pan-European bank if the European Union is fragmented. It will not, and no other bank can do that.
So in other words, are you telling me that you're not going to go out and buy anything in any of the countries in which you currently have a footprint, in Germany, in Italy, or any of the other countries in Europe in which you don't have a footprint until there is movement toward this banking union?
What I'm saying is that at the moment, the incentives to do M&A are limited to countries where you're local. We're local in 13 countries. Other banks are local in 2 or 3. Other banks are local in 1. Once you cross the border, if you do not have a unified market and free-flowing capital, free-flowing liquidity, and common rules, your synergies plummet. And therefore, there is very limited incentive to pursue that.
Andrea, people here have a few questions about the economy, as they should. Bank balance sheets are supposed to be one of the chief transmission mechanisms for monetary policy. Here in Europe, as you've alluded, the ECB is still trying mightily to slow inflation. Are you tightening access to credit?
Well, I think that you go back to what is the broader picture. You go back to what should bank be doing. So if banks are a transmission mechanism, and they are, and if capital markets are underdeveloped in Europe, as they are, whatever monetary policy you want to have or economic policy, you need to use the banks. So if you provide more liquidity but restrict the banks from multiplying it, then you're working against yourself. And at the moment, regulation and objectives are not.
They're not aligned.
They're not aligned. So, because the regulation is to make banks strong, not take risk, etc. But when you have a recession, what are you doing? When you have COVID, what are you doing? You're flexing. And so if you flex and it restricts on the other side, you have two opposing objectives. As far as we're concerned, we are very well capitalized, we're very liquid, and we see this disruption, or this uncertainty more than disruption, as an opportunity to bring to bear our strengths. So we're not restricting. We're disciplined. We know where we want to expand, where we don't want to expand. We look very closely at risks. But at the moment, our stance is one of steady as she goes and probably trying to gain share, not lose it.
And what about credit quality? What about the quality of your loan book?
Well, this is one that is a very interesting question, because I think everybody in the room will look at what's happening with inflation, what's happening with energy prices, what's happening with let's say the P&L of corporation or the budgets of families below a certain level, and you would say your credit quality is going to go really bad. But we started saying that since the invasion of Ukraine, and every quarter the banking system has registered record low cost of risk. So it does seem that the transmission is not happening. My views is that the economy is very different from what it was before, in as much as government intervene in certain sector, intervene in certain segment of population with subsidies and with incentive, and it's fragmenting the way the economy is reacting. That said, our base case is that the cost of risk that we have this year will remain at the same level as we had it last year. That's the scenario that we have. We have, as of April, no indication of a worsening of our cost of risk, not in corporate, not in retail. And however, because we're not sure we're right, we have 1.8 billion of overlays in case things go the wrong way. So it's almost like we're managing for the central scenario, and we're looking at what we see, but our mind is telling us that maybe we're missing the iceberg, and if we are, we have something to protect us.
Andrea, you told us earlier that the future you see is one of uncertainty, uncertainty, uncertainty. What kinds of crises should we be preparing for?
Well, I think one of the key things that I probably learned in my days of investment banking is that the next crisis is never the same as the prior one, because everybody is very focused. Now we're all focused on liquidity.
That's in the rearview mirror.
Okay, how much have we been focused about liquidity in the last 10 years?
Not.
Interest rate risk, how much have we been focused on interest rate risk in the last 10 years? Okay, so now it's shocked. Now we're very well aware. And now the question is, what else? Is it climate change? Is it disruption of value chain? I mean, we underestimate the effort that certain companies, you take an automotive company, somebody was telling me that if you are building an internal combustion engine in Germany, your dependence from Russia used to be de minimis. On an electric car, more than 50% of value parts. So that does not mean, what does that mean? That means that we need to reallocate the entire value chain away from the provider somewhere else. And by definition, it's going to be more expensive, and the speed of obtaining the parts and what you need is going to take longer. That means that entire sectors are redefining their logistics, their providers, their cost of production, and all of that is happening in a compressed timetable where you have uncertainty in the economy, and therefore you're asking yourself, am I investing too much because the world is growing only at 1%? or 2%.
Fascinating conversation there between UniCredit Group CEO Andrea Orcel speaking to Eric Schatzker at the Bloomberg New Economy Gateway Europe in Ireland. Really fascinating lines on the cost of risk, really interesting on the fallout, of course, of the banking crisis and the changes more broadly, the fundamental changes that are happening in this economy, saying that we're not concerned in terms of contagion, pretty worried about the contagion at the beginning of the crisis in terms of a lack of confidence, but now they are thinking differently, he said, about deposits and funding, and saying that in terms of M&A, and that's a big question, of course, across the European banking space, consolidation, in terms of M&A, that the incentives for cross-border M&A in Europe are pretty limited. Coming up, we are going to be sticking to Bloomberg's New Economy Gateway in Ireland. We're going to speak with IATA's Director General, Willie Walsh. Really interesting conversation coming up then about travel and the pickup that we're seeing, whether it can be sustained as airlines get back onto a slightly surer footing. That is coming up. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back now. Bloomberg New Economy is hosting its inaugural event in Europe, which will bring together regional leaders to discuss the most pressing issues facing its economies. Let's cross over then to Ireland, where Francine is standing by with a guest. Francine.
Thank you so much, Tom. I'm delighted now to talk aviation. We were just talking before about healthcare with AstraZeneca. Then we heard from Andrea Orcel on banking. And now we're delighted also to be talking about aviation with the IATA Chief Executive, Willie Walsh. Thank you, Willie, for joining us. I mean, jet fuel, inflation, there's so many concerns out there. How are you expecting that to impact the aviation industry in the next 12 months?
Well, I think the positive is demand remains strong. And when we look at, high oil prices, we've seen that before in the industry. Inflation, we've seen that before. If you've been around long enough, these are business as usual challenges. And it's clearly a much better environment than it was over the past 3 years.
But then we talk about a possible recession, and we haven't really, there's a mismatch between what chief executives are expecting, what companies are expecting, preparing for the worst, and actually the real data in the economy. How are you expecting, I guess, the recession to play out and what that means for consumer demand on traveling?
Yeah, I think most talk of recession has eased a little bit. Certainly if you go back 3 months ago, I think there was a lot stronger concerns about recession. The interesting thing we are seeing, though, is employment levels remain quite high, and therefore I think people still have confidence in spending money. So it's quite different to situations we've seen in the past, where typically these concerns about recession were also associated with higher and increasing levels of unemployment. So it's a different scenario today, and all of the CEOs I'm talking to in the industry remain cautiously optimistic about the outcome for this year.
But different scenario because you think the recession will be shallow, or also because there's still this pent-up demand because we were locked up for 3 years because of COVID?
Yeah, clearly demand remains strong, but I think there's another factor from an airline point of view, and that capacity is not coming back as fast as maybe people had expected, and some of that is because of disruption to supply chains. A lot of airlines are having difficulty getting spare parts. There's delays in the delivery of new aircraft. So we're seeing quite a good match between the increase in demand and the increase in capacity.
How worried are you about these supply chains, and actually how long this will last?
Yeah, I think it is a concern, particularly in relation to the spare parts. It's pretty much every airline CEO I talk to now is expressing concern, and there doesn't appear to be any near-term fix. So this is probably something that will continue into 2024 and maybe beyond. But we would expect the manufacturers to get this issue sorted out by then.
But so that also impacts, real deliveries of new planes.
That's correct, and the existing or the older planes that were in operation that were grounded in 2019, they're not coming back into service as fast as people expected because the parts aren't there to get these aircraft back in the air.
With China reopening, what impact does that have on air travel across the world?
Yeah, that's been a positive because we didn't expect China to open in January. So if I look at international travel within Asia, last year it was at 22% of where it was in 2019. In February, we were at 57%. So we're seeing capacity and demand coming back in Asia. It's a bit slower than maybe people had expected, and I think that's because people remain a little bit cautious. And some countries still had some travel restrictions in place. So it's a positive, definitely, but I expect European airlines to be a bit more cautious about adding capacity into China than the Chinese carriers into Europe.
Can aviation do a lot more when it comes to climate change? Or actually, given also the situation with fuel because of Ukraine, that seems to have taken a little bit of a backstep?
No, I think the positive is that even through the recession, airlines continue to invest in sustainable fuel and make commitments to further, future purchase of sustainable fuel. And despite the crisis, every single drop of sustainable fuel was bought by the airline industry in 2021, 2022, and again this year. So we're absolutely determined. We've made a commitment to net zero in 2050. We know what it is we have to do. What we're looking for is some government policies to support the production of sustainable fuel, because there's no issue with demand. I've heard some people say that they need to see demand signals before they'll build the capacity. The demand is there. It's real. Airlines want to buy it. We just want to see it in greater quantities.
Willie Walsh, thank you so much for joining us. That was the Chief Executive Officer of IATA. With that, Tom, I'm going to send it back to you, and then we'll have plenty more throughout the day here in Ireland.
Okay, great stuff. Bloomberg's Francine Lacqua, of course, on the ground in Ireland at that event. Coming up, UK inflation coming in hotter than expected. We discuss what this means for the Bank of England. That is next. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, to one of the top stories of the day. UK inflation has come in hotter than expected, 10.1%. A reminder that the UK is now the outlier. 6.9% in the Eurozone. We're going to get refreshed data just in the next couple of minutes out of Europe. 5% in the US, 10.1% here in the UK. Let's bring in Christine Aquino, Managing Editor for Bloomberg Markets Today. And Christine, there has been a market reaction to this data.
Absolutely, Tom. It wasn't entirely clear, though. If you're looking at the pound chart, there was a really clear spike initially after the inflation print. And then I think traders were realizing that, oh no, more BOE rate hikes, potentially bad for consumers in the long run. And so we saw a dip in the pound. Eventually, it ended back up again. So I think traders are still trying to make sense of the immediate impact. I mean, it is positive in the short term, but in the long term, they're questioning what this all means. If the BOE ends up doing more rate hikes than they expected, what is that going to mean for consumer debt, household mortgages, and things like that in the long run?
And gilts selling off. You're seeing that quite pronounced at the front end. A 13 basis point move higher in yields, 382 at the front end. Gilt 2 years. What does it mean for the BOE? Where are the markets then in terms of pricing in May, June and beyond for the Bank of England?
Well, I think they're definitely nailing on those expectations for rate hikes, definitely for May as well as June as far as the markets are concerned. And the Bank of England, I think, is going to have to follow suit just because in a combination of today's data as well as yesterday's unexpected wage increases really just drives home the point that inflation in the UK is proving particularly sticky, especially compared with the Eurozone and the US. Both of those are single digits heading in the right direction. That's really just not the case for the UK.
A different story, and political costs arguably as well for the Prime Minister as he continues that pledge around halving inflation by the end of the year. We'll see if that indeed comes to the fore. Always excellent, of course, breaking down the market reaction to that CPI print out of the UK. Christine Aquino. We're also minutes away, as I mentioned, from the March inflation print for the Euro area. That after ECB Chief Economist Philip Lane told us he is backing a rate hike at the next meeting. European markets down 0.3%. Futures in the US lower by 0.4, 0.6 on the Nasdaq futures. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller in New York and Anna Edwards here in London. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I think there's going to be more volatility inflation over coming years, and I suspect on average it'll be higher.
Inflation is going to fall back to 2%. The European economy is not going to go into recession.
If inflation targets remain as they are, and we do have central banks keep pushing to try and get inflation back down to target, there is this risk to the economy. There is this risk that something else breaks.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Job cuts on the way at Meta and Disney. Thousands of positions are being eliminated starting today. New figures strengthened the case for the Bank of England to raise interest rates once again. Britain's inflation rate remained in double digits last month. And how does Morgan Stanley stack up against its Wall Street peers? The bank reports its earnings in 2.5 hours' time. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. The inflation story certainly dominant here in Europe today, Matt. Over in the United States, we focus on banks, and futures slip a little. Some negative sentiment perhaps from some earnings.
Yeah, well, and I feel like the UK inflation story is actually reverberating around the world, because a lot of people are now expecting tighter rates or higher rates for longer. We had comments from Bullard yesterday saying he wants to go between 5.5 and 5.75. He's not a voting member, but he makes some very strong points. Let's take a look at what's going on in U.S. markets. We are now down about 0.4, almost 0.5% on S&P futures. We managed to eke out a gain in the cash trade yesterday, but the Dow and the NASDAQ both closed down. So the S&P was kind of the outlier there. We have bonds down as well, and that pushes the yield up another 4 basis points. Wow, 420. We're almost there, by the way. Right now, 361.76 is the level on the 10-year, but you see yields going up much higher on the 2-year on the shorter end of the curve, as well as investors maybe starting to price in more than one rate hike. NYMEX crude is off about 2% right now. We're down below $80 a barrel, and we've fallen below key levels on a lot of big commodities. Bitcoin is down about $1,000, under 30 right now. NYMEX under the $80 handle. Gold down under $2,000 right now. Right now it's off 1.3%. It fell a little yesterday as well. So gold is now under $2,000, and we see just a lot of selling in these markets. Take a look at what's going on in Asia. You saw a drop there as well on the MSCI Asia Pacific Index, down 0.8%. The Hang Seng down 1.4% at the close, and it had been lower, so it was able to offset some of those losses into the end of the session. The Nikkei in Japan off, but only about 0.2%. We do see dollar weakness, not against the pound. I think the pound is still up against the greenback, but we see dollar weakness against other currencies like the euro, and a little bit of dollar strength against the yen right now. 134.86 is the amount of yen. You can almost buy 135 yen for $1. What do you see, Anna, in Europe this morning?
Yeah, the inflation story certainly dominates then, Matt. We've just got Eurozone inflation, the final reading for the month of March. So this didn't tell us anything we didn't know, in case in fact, the number came in exactly as expected. So Euro area final March reading on inflation, CPI rising by 6.9%. That was exactly what the preliminary said. So as you were on that front, but that is still a lot lower than it was. It is a lot lower than the UK inflation story right now, which is certainly dominating news flow here. And we've got earnings stories as well in the mix. So this is what we see at the moment. Negativity, broad-based, but fairly modest negativity for many of these European markets. The London market sells off a little bit more than the others. Here's the euro, not much movement as a result of that inflation data, as I said, came in pretty much as was expected. We did see a boost to the pound. In fact, the pound took some time to understand exactly what it meant to see that inflation print once again come in above 10%. So double-digit inflation, still a reality in the UK. It has been expected to drop down below 10% for the last two monthly readings, and that has not happened. So the pound spiked up on that on the BOE impulse, but then dropped and then spiked up again. So a lot of volatility there. UK two-year yield taking no time to decide what to do, to price in with more certainty a May interest rate hike from the Bank of England. So that's the bond markets quickly deciding what this means, and also pushing out that peak rate, or increasing, sorry, that peak rate where the markets think the BOE will get to. Here are a couple of earnings stories to focus on with different dynamics, actually. Heineken, the drinks maker. Interesting that the volume numbers were light versus expectations, but because European drinkers seem to be happy to continue paying up for those drinks, the investor community seeing something positive in that, and the stock up by more than 3% as Europeans turn to drink, perhaps. ASML down by 2.5% as we have the company that supplies the companies that make the chips. There have been a lot of negative expectation at the beginning of this week around what demand out of Taiwan in particular would look like. Some of that is sticky, and despite the earnings story we got out today, the outlook for the second half of the year a little hazy, and so as a result the stock is down.
Europeans aren't turning to drink. It's in their DNA. They're just turning it up a little, I guess. All right, I think the ASML story is fascinating. We're going to be watching that, as well as the chip news that we've gotten from other behemoths like TSMC cutting CapEx. It doesn't look good for the global economy. Neither do the job cuts that we've been seeing overnight. Disney plans to cut thousands of jobs next week. That's what Bloomberg's learned. That includes about 15% of the staff in its entertainment division. This is a company with 220,000 employees. Meanwhile, Facebook owner Meta is set to begin company-wide layoffs today. A memo seen by Bloomberg indicates that Facebook, WhatsApp, and Instagram, as well as Meta's virtual reality lab, will all be impacted. Bloomberg's Alex Webb joins us now for more. So, Alex, we've seen, you know, that on the tech side, on the West Coast, we've seen some of these job cuts, but they're now starting to really ramp up and going into other areas like entertainment, communication services, media streaming.
Yeah, it's very much time of reckoning for these companies that had absolutely been classified as growth stocks for a few years. Disney, had pivoted from value to growth under pressure from activist investors. It's now retrenching. It is laying people off from its entertainment division. The push had largely been towards Disney Plus, as we've seen interest rates come up. We've seen people not spending as much time in front of their devices as they've come out of the lockdowns. That has hurt the efforts with things like Disney Plus. Meta, of course, one thing that is fascinating with their job cuts, according to sources according to a memo seen by colleagues in Bloomberg News, they are cutting the Reality Labs division. That is their metaverse effort. That's supposed to be the future of the company. It's a division that that Meta has really ceased to talk about with quite so much volume as it was, even a year ago. So we are seeing something of a retrenchment from both these companies.
Okay, a focus on cost cutting then in terms of those tech names. What about the Netflix earnings story then overnight, Alex? The earnings and then the crackdown on password sharing.
Yeah, there were three numbers that were really important here. The first quarter subscriber growth wasn't as high as expected, 1.75 million versus the 2.4 million expected by the market. The second quarter revenue was also short of expectations. That took the stock down about 12% in after-hours trading. But then as people started to look a little more deeply at the numbers, the expectations for the second half were quite good. Free cash flow, $3.5 billion. That was above expectations, above the company's forecast of $3 billion. They've increased that forecast. Part of that is to do with cracking down on passwords. It didn't happen in the first quarter, but what they're doing is they think there are 100 million people out there sharing passwords. If they can get some of those to subscribe, then that will benefit subscriber growth.
Yeah, interesting. They've been trialing some of those strategies for that crackdown in Southern America. Thanks very much for that. Bloomberg's Alex Webb joining us with the latest tech themes. Let's pivot to the macro. And UK inflation has come in hotter than expected, with the March CPI reading rising 10.1% year on year. Economists had expected that number to drop into single digits to 9.8%. This comes after Tuesday's report showing UK wage growth accelerated unexpectedly last month, adding to inflationary pressures concerning the Bank of England. Joining us now to discuss, Christine Aquino, managing editor of Bloomberg Markets Today. Christine, very good to have you with us. So we've got this combination of faster inflation and more rate hikes. Is that what is ahead? More rate hikes from the Bank of England?
I think that's definitely the conclusion from markets, and I think we see from the pound reaction as well as the gilt losses today, most signs in markets are pointing to that expectation that the Bank of England is going to have to do more, and that's probably not something that Andrew Bailey and his colleagues really want to hear, because they were guiding markets toward expecting less, even from the start of this year, and even the most recent comments from them, despite the fact that we have double-digit inflation still persisting. But I think after today's data, as well as yesterday's wage data, most signs really are pointing to the Bank of England having to add to those rate hikes.
So are people worried about a policy mistake here from the Bank of England, as they are, in the U.S.? And how are traders expected to react?
Well, Matt, yeah, definitely thinking about the potential mistakes here. I think initially, given that the guidance from the Bank of England was for markets to expect less in the way of rate hikes, but we just kept getting persistently high inflation readings. It hasn't dipped down to single digits for a few months now. And I think that's where potentially the initial mistake was, right? That initial guidance for less in the way of rate hikes, and now having to potentially backtrack on that given the inflation print. But I think toward the back half of this year, the potential mistake could probably come from expectations of the Bank of England having to pull back on their efforts because of the impact of rate hikes. It's a very similar dynamic to what we've seen in terms of how markets are trying to read the Fed, right? They're kind of trying to think, well, the rate hikes are going to be negative for the economy eventually, and therefore expect rate cuts. But just given the persistence of inflation in the UK, it's going to be hard to see a situation where that would be viable even in the second half of this year.
All right, Christine, thanks very much. Christine Aquino there talking to us about 10.1% inflation, beating the estimates on kind of the wrong side yet again. Let's get back here to the U.S. Legendary trader Lee Ainsley of Maverick Capital sees inflation increasing once the war in Ukraine winds down. He spoke at the Economic Club of New York yesterday in a rare appearance.
My thinking is that the baseline inflation underneath all this is actually continue to march upwards. Decarbonization, deglobalization, people miss just the aging of our populations. The active workforce is shrinking. That's part of wage inflation. And so I do think particularly wage inflation may be a little stickier.
Shonali Basak, our global finance correspondent, joins us now in studio. So Shonali, We heard it from Ainsley there, concerns that this inflation is going to be persistent.
Yeah, you definitely have one of the most well-known Tiger Cubs now beating that higher for longer drum, something we heard from Jamie Dimon just about a week ago. And listen, there are some very interesting implications for the hedge fund industry in particular. Some of the things he pointed out was what this would mean for the pod model. Remember, a lot of these multi-strat funds run on a lot of leverage. And so what does it mean as interest rates go up, not only for their own models, but the competition for money? The other thing he talked about, Matt, is what it means for the crossover fund model. A lot of these hedge fund firms have gone into the private equity business, which also requires significant leverage. And, it's an interesting equation once you think about the capital calls they also need to keep making to try to meet those new investments. So remember, David Solomon yesterday over at Goldman Sachs got a question from an analyst about the worries about the hedge fund industry. His answer really was that Goldman in particular is flocking to the top 100 funds. And so you do see a washout in the industry that has already been at bay, but how the banks react to the industry and the leverage they're willing to provide them, the business they're willing to provide them, will really set the stage for the investing world in the next year or so.
And we've seen how quickly that can come unstuck in the past, haven't we? Let's get to the bank earnings story. Morgan Stanley set to report numbers. What do we expect to see here then, Shanali?
Yeah, one is on the trading side here, again, because Morgan Stanley is one of the biggest prime brokerages on Wall Street, has historically been the largest equities trading shop on Wall Street. While we watched Goldman miss on fixed income yesterday, they beat on equities trading. So it is a soft market for equities trading, but will Morgan Stanley still hold strong in that market after last year kind of falling behind Goldman for a couple of quarters? The other thing we'll want to watch is what they have gained in terms of business in the wake of Silicon Valley Bank's troubles. Remember, Morgan Stanley would arguably want to be one of the biggest beneficiaries here, Anna, because Morgan Stanley had such a big base of high net worth clients. We have seen, there's no other way to put it, the biggest banks really benefit in the wake of this storm. Things are looking like they're starting to stabilize, as we saw from Western Alliance's own numbers yesterday. But how much has Morgan Stanley won, and how sticky will some of that business be?
All right, our top Wall Street reporter, Shanali Basak, thank you so much for joining us this morning. Now let's get a look at some of the stocks we're watching in pre-market trading here in the U.S. this morning. Keeping an eye on regional banks because Western Alliance has surged as deposits rise by $2 billion this month. You can see the stock there up 15% in the pre-market. PacWest up 4.33% in sympathy. So watch those regional banks in this morning's trade. Intuitive Surgical reported worldwide procedure growth for the first quarter that beat analyst estimates. You can see the stock up 7% in the pre-market. Procedure growth worldwide, so surgeries that it's done, was 26% higher than it was at the same time last year. The estimate was only for 15% more procedures. HP and Dell are among some of the technology companies that are falling in the post-market trade. You can see HP here down 2% in the pre-market trade. They were down obviously in the post-market yesterday as well. IT products and services company CDW reported preliminary quarterly results that missed. And then Tesla cutting the price of its highest volume models yet again in a further sign that the chief executive officer Elon Musk is willing to sacrifice some of the industry-beating profit margins that Tesla has in order to build even more demand. The Austin-based automaker marked down some more Model Ys and Model 3s, an average of about 5%. But I think they've cut prices now like 5 or 6 times so far this year. So a lot of consumers, Anna, are maybe waiting to make a purchase for that next price cut.
And we will get some analysis of what to expect from Tesla in the earnings story there shortly. We also got European car sales numbers showing some robustness as we say goodbye to some of those supply chain issues post-pandemic. And now, just to tell you what's coming up on the program, we will be speaking to Fishka Maharaj, multi-asset strategist at JP Morgan Asset Management. How is she playing the current environment in markets? What does she make of the latest inflationary drivers that we're seeing here in the UK and perhaps elsewhere as well? And Callum Pickering joins us, Berenberg's senior economist, also to weigh in on the inflation story. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Q1 suggests we are seeing a reversal of the negative supply shocks that so dominated the European economy last year. So easing of bottlenecks, much lower gas prices. So what I would say from all of that is, as of now, 2 weeks away, I think the baseline is that we should indeed increase interest rates in May.
That was the ECB chief economist, Philip Lane, speaking at the Bloomberg New Economy Gateway Europe conference in Wicklow in Ireland. Bloomberg TV and radio are broadcasting live from the conference. We've heard from a number of leaders from the private and public sectors today. Tomorrow we'll hear from Ireland's Prime Minister, Leo Varadkar, among other voices. Joining us now here on set to talk about global strategy, Thushka Maharaj, multi-asset strategist at JP Morgan Asset Management. Thushka, very good to see you. We heard Philip Lane talking about the inflation story, but I'll start with the impact of the inflation story here in the UK. How does this influence your thinking around asset allocation on UK assets, given inflation still double-digit, food inflation running at not quite 20%, but high teens?
Yeah, thanks for having me, Anna. You're right. Inflation, we've had a very timely reminder that the inflation, stubborn and persistent inflation is here to stay for longer. I'd say the UK is a particular example where you have twin shocks that you are dealing with, both the labour force participation being weak and the energy shock. And for us, that complicates the Bank of England picture. What does that mean for our views on UK assets? We are warming up to duration, so core gilt bonds. But today's data does add some volatility to that. The reason why we are looking at the gilt market as a positive market to own duration in is essentially the market is pricing in over 50 basis points of hikes from the Bank of England, and we want to diversify duration across markets. On the equity side, we actually are more positive on UK equities, but that's because of global factors rather than specific UK ones.
Right, yes, as is so often the case with UK equity conversations, it's a global story, perhaps at least at the FTSE 100 level. What about more generally then, your outlook and your positioning? You said in your notes ahead of our conversation that's pretty cautious. What does cautious look like?
Cautious means we are modestly underweight risk assets, so modestly underweight in equity markets. And the rationale for that is unlikely to see significant upside for risk markets in the current environment. As you mentioned, inflation remains a concern that keeps central banks in their tightening path. We have already had a reminder in March that policy is already tight, and we will see credit conditions tighten further, and that caps the growth outlook in the medium term. So essentially, this idea that equity markets have run a long way, the upside is capped, that keeps us cautious. But at the same time, the caution we are expressing today is actually in being long duration. We see more asymmetry on the bond outlook, better return profile there than we do in equities.
Okay, Matt.
Yeah, it's interesting, Thushka, because we have seen bond spreads tighten and the VIX drop to below 17. At the same time, I'm hearing the term credit crunch more and more often. You said we could see credit conditions tighten. How much? And could it be to a concerning level? Because it looks like relative calm in markets, both in bonds and in stocks.
Yeah, that's a valid point, Matt. And I think you're honing in on the exact question we're facing ourselves. Is this going to be a sharp, quick drawdown in growth expectations, or is it a slow burn, grind lower in the economic outlook over the next 6 to 12 months? And I'd say credit availability, loan growth, and the labor market are key in sort of answering that question. So firstly, on the credit side, we are expecting slowing of credit availability. That for us takes off maybe 2/10 or 3/10 on GDP over the next 6 to 12 months. But we're not seeing it creating this big cratering crunch in credit conditions. So we are more in the camp that this is a slower grind lower in the growth outlook, and it will take time to play out. And as you mentioned, there are two-way risks around this. We're already seeing deposit inflows, as you mentioned earlier, coming back to some of the regional banks in the US. So it's more of a slower grind, and we're looking for opportunities for where we could be cautious, but be willing to wait this out as growth slows.
Yeah, I mean, a lot of people are looking at the banking crisis in our rear view mirror now. We're seeing Jess Metton from our equities team, as well as Cameron Kreis, our macro man columnist, saying, look, expectations of a recession were much bigger at the end of last year and at the beginning of this year than they are now. Jim Bullard, obviously you're not going to have the Fed come out and push for a recession, but he's saying, I don't see it here, especially with the labor market that we've got. Are expectations of a recession now lower than they were previously, meaning risk assets have a chance to continue this run higher?
Yeah, so we have increased our recession risk post the banking stress in March, but it's not our base case. We're not in the camp that we are like that recession's nailed on and that we need to be extremely cautious. What's keeping us cautious is that even in our relatively positive view of the economy, we think risk markets have already run a long way, and in the positive scenario, central banks are still hiking, so they are raising the cost of financing as growth improves, and that caps the upside for risk markets. But what you highlight is a valid point. Where can we look for that asymmetry? And credit or high quality components of credit are starting to look attractive in our base case scenario. Recession risk for us, I'd say, is a bit, is between a 25 and 30% likelihood over the next 12 months in the US. But look outside the US, growth in Europe, China, we are seeing a much better outlook there. So it's very differentiated across the globe.
All right, Thushka, great to have you on the program. Really appreciate your insight. Thushka Maharaj of JP Morgan Asset Management talking to us about really the importance of active. You've got to pick your spots for that opportunity. Now, keeping you up to date with news from around the world, here's your first word. Senior Russian officials have raised concerns that the war in Ukraine has left Moscow too reliant on Chinese technology after the U.S. and EU sanctions shut off access to alternative suppliers. An internal Russian memo suggests Moscow is cornered and concerned that Chinese technology reliance may pose a risk to Russia's information security. Fox News has avoided a potentially embarrassing trial. The network agreed to settle with Dominion. They'll pay $787.5 million to settle that voting machine maker's defamation lawsuit over its 2020 election broadcasts. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Job cuts on the way at Meta and Disney. Thousands of positions are being eliminated starting from today. New figures strengthen the case for the Bank of England to raise interest rates again. Britain's inflation rate remained in double digits last month. And how does Morgan Stanley stack up against its Wall Street peers? The bank reports its earnings in 2 hours' time. I'm Anna Edwards in London with Matt Miller in New York. And sentiment deteriorating the closer we get to the start of US trade, it would seem. The inflation story out of the UK certainly catching our attention from the macro standpoint, but a lot of corporate earnings to focus on as well.
Yeah, I think we had Goldman Sachs and Johnson & Johnson yesterday dragging on the indexes, and now you've got this big inflation number out of the UK, I think igniting a little bit more concern around the world that that inflation could be higher for longer and rates may have to go higher with them. We heard from Bostic, we heard from Bullard, and we'll talk about that in just a little bit. S&P futures are down about 0.5%, a little bit more now than 0.5%, and you're seeing a lot of selling in this market no matter where you look. For example, investors are selling off the 10-year note, and so the yield rises another 4 basis points right now, 361.57. Selling off NYMEX crude, we were at an 80 handle or above, really. I mean, we'd gone up to $80 a barrel post OPEC plus surprise cut. Now we're coming back down below $80, and even Brent is looking pretty weak. Gold had been up above 2,000. We were on all-time record watch to see if it could eclipse 2,075. It's now back down below that, not terribly significant, but big round number of $2,000 a troy ounce. And even Bitcoin, for example, is down about $1,000 below 30,000 right now. So investors are really taking some chips off the table. Take a look at some of the movers here in terms of individual stock stories. You have some good news. Western Alliance rising after the bank beat earnings estimates and said deposits recovered. You can see Western Alliance is up, and then other regional banks are gaining in sympathy, but 15% is better than a stick in the eye. Intuitive Surgical, also a big gainer, 7% this morning, saying that worldwide procedure growth for the first quarter beat the average analyst estimate. They did about 26% more procedures than they did in the same quarter last year, and the estimate was only for 15%. Netflix, on the other hand, is down 1.5%. We talked to Alex Webb about this just about 15 minutes ago. Netflix is down as investors are weighing customer additions and the firm's outlook. First quarter new subscribers came in at 1.75 million, and that missed some forecasts. It beat some. Netflix will start to crack down more on password sharing in the U.S. this quarter and predicts that that will boost growth in the second half. Because people who have been thus far, I guess, stealing Netflix are going to have to actually pay for it. And then Tesla cutting its prices again on some Model Ys and Model 3s. These are the more affordable models that Tesla has in the lineup. And another sign that Elon Musk is willing to sacrifice some of his industry-beating profit margins. They have profit margins that big automakers would do a heck of a lot for, like 14, 15% rather than 7 or 8%. So they can afford to sacrifice that to get more sales. But the question is, if they continue to cut prices, Anna, do you go out and buy a Tesla, or do you wait for the next price cut that you expect? That's the problem with deflation, right?
Yeah, absolutely. And there's a lot of thinking around how customers behave with expectations around inflation very much in their minds at the moment, because we talk about it all the time. Let's get to the European equity market picture then. Stocks Europe 600 down by 0.4%. And inflation is one of those themes that we're very much focused on today then, Matt. In the European context broadly, we had Eurozone inflation data confirmed at 6.9%. Higher, of course, than the ECB wants to see it. And we heard from Philip Lane in that exclusive conversation with him at the ECB, saying that he thinks we need to see another interest rate hike. And the expectation in the market is we see a lot more hikes, really, from the ECB, certainly versus the Fed. The euro, though, not moved by that particularly, 109.32. It was an inline inflation number. The two-year yield, though, certainly moved by what we've heard here in the UK. A 12 basis point move on two-year yields. Increasingly expecting in the markets that we will get another hike from the Bank of England then in the month of May. The expectation around that seems to have firmed up because that inflation print came in the UK at 10.1%, above 10% essentially, and not dropping down into single digits as had been the expectation. So really sticky there. Food prices. We haven't seen food prices like this, Matt, since you and I were very small, put it that way. Food price growth like this, I should say. ASML is down by 2.7% on the earnings story, just covering off that one here in Europe. It's not about the backward-looking sales. They were okay. It's about the forward orders, and that seems to be weighing on the stock today.
I remember when I was a kid, I could buy a candy bar for like a quarter. It'd be great to see food prices like that again. But yeah, I get what you mean. This kind of inflation is just shocking. And I think that the UK numbers are concerning even here in the US as well. Joining us now is Callum Pickering, Berenberg senior economist, to talk about this, the second time in a row that we've had expectations for UK inflation to fall below 10%, and yet it holds fast. What's going on, and is that kind of stickiness in prices going to be felt in Europe and in the US as well, Callum?
Well, I think we just need to be a little bit careful putting too much weight on upside surprises when we have fundamentals pointing towards disinflation. And so, of course, we have to be cautious. The Bank of England will be, relative to its February estimate, surprised by what Q1 inflation has done. No question, and therefore that supports the hike again in May. But the balance of demand and supply is pointing towards disinflation over the course of this year. You have big energy base effects to wash out. Monetary policy is not by now tight. Fiscal policy is by now tight. Producer prices have turned down a lot, and actually money supply data, which had been the key leading indicator for the inflation even before the war, has normalized. And so I think we should just be a little bit careful. It's very hard on a monthly basis to calculate this stuff, and therefore if the market's off by 0.2, 0.3, it's often not a big deal in hindsight, and we have had downside surprises before these upside surprises. So I think it argues for caution, let's go again in May, but it doesn't argue for worrying about persistent or sticky inflation just yet.
Callum, to ask a question that probably seems completely inappropriate today, because today is about firming up expectations for a May rate hike. Yep. When do we get to cuts from the Bank of England? If we continue to see food price inflation moving at the pace that it is, and we do see cracks in the labour market, even if the wages story is much stronger, when do we get to the cuts part of the UK conversation?
Best bet would be in Q4. We can see some cuts from the Bank of England, but the Bank of England will be, even as it cuts interest rates, arguing that we're not going to cut aggressively. We're just going to go steadily. It's a normalization of interest rates towards longer run equilibrium levels, which we think are around 3%. So our bet is 50 basis points in cuts in Q4, probably 100 basis points over the course of next year, and then the Bank of England holds. The key point in all of this is that we've raised interest rates a lot, and every time I fly over Europe, I check out the window and I say, are the mountains still standing? The answer is yes. 2017, the whole world was worried about the Fed raising by 25 basis points. What's going to happen? Now we can raise interest rates to 4 and 5%. We see that actually fundamentals are still good. And it's not just inflation and wages which surprise to the upside, it's output. The whole market, including goods, has revised our forecasts up since October because data have come in better than expected.
Now, it's easy to see how, in a sentiment sense, and on a fairly quiet day, frankly, this story goes a bit global and people start to ask questions about sticky inflation globally. But there are some very specific UK factors at work here, I assume. I mean, European inflation has dropped right down. There's a lot of divergence within the Eurozone, but 6.9% is the total number, and US inflation has dropped a lot further. So there are limits to how much this tells us about outside the UK.
It's all still too high.
Yes, it is still too high. I agree with you. And I recall over the last few weeks heading into the supermarket and not being able to get basics such as salads and other food stuff. There were some weird idiosyncratic issues in the UK linked to food shortages. So that could be playing a part here. But again, on a monthly basis, lots of things can move CPI indexes. In the longer run, in the medium term, it's fundamentals. We know that over the next 18 months, the fundamentals are disinflationary. I think if you go even further out, it then starts to turn a bit more inflationary. We start to think about deglobalization, aging populations, fiscal policy is still expansionary, especially in the US. Households are willing to spend some of these buffers that they've built up during the pandemic. And so we still have to be cautious around the inflation outlook, but I think we have to worry much less about where inflation is, say, a year from now, but worry a lot more about where it is, say, 4 or 5 years from now.
Is Brexit still a problem for the UK economy that that Europe and the US don't have to deal with? Is it still substantial?
It's a long-run friction. We've raised costs of trade with the EU significantly, but it's not the explanation for the upside surprises that we have now. I would not be surprised, actually, if the UK suffers more disinflation, say, next year than the US and the Eurozone, partly as a bit of a compensation for what we see now, but actually because fiscal policy is tight in the UK, whereas it's not in the Eurozone or in the US. I would just make a bigger point here, which is to say, inflation is a bit of a sideshow. Just look how the world has changed. Central banks are raising interest rates. Economies are still surprising to the upside in terms of economic activity. But more than that, central banks are willing to give us recessions in order to normalize inflation. This is in complete contrast to the way the world looked after the financial crisis. My view is now the world looks a lot like it did, say, in the 1990s. It's normal business cycle dynamics. It's normal reaction functions by central banks. And these upside surprises in wages and inflation and in economic data more broadly are part of the fact that the world is just in a better place. Economies are stronger.
Speaking of sideshows, can we get a 2-box? Anthony, can we look at this?
I was going to say, you look fantastic, Mel.
You look amazing. I love your style, Callum Pickering. Thank you so much for joining us.
Thank you so much.
I'm glad you're both enjoying that so much. Yes, you both look fabulous. I appreciate the style that you both bring. Right, coming up on the program, Tesla is cutting prices again ahead of earnings today. Matt's mentioned this a couple of times. We'll get a preview of the results. They're due out later today. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, Tesla is cutting prices once again. That's the second time this month as CEO Elon Musk seeks to boost sales ahead of earnings being released today. Joining us now for more is Bloomberg Global Autos editor Craig Trudell. And Craig, I find this story so fascinating because on the one hand, Tesla has such significant margins. It's the envy of the rest of the industry in terms of the profit that it makes on each car sold. So it's doing very well. On the other hand, it faces such incredible competition. The biggest car makers in the world are after Tesla's lunch. So what do you make of these continued price cuts?
I think it's incredible because what you're talking about does speak to, there's a sort of debate raging among the analyst community, among investors, of is this a sign that this company is in trouble, or that Musk is a sort of mad genius who's going to sort of take out the established car makers? And you have people who have strong feelings on either case, making either case. I think it's really incredible to see the frequency with which they're cutting prices this year. This is at least the sixth major set of reductions that they've done. And I think at this point, you do have to wonder, to what extent are these cuts not having the sort of desired effect of a boost in demand on the basis of, if you're a consumer, why would you buy right now if Musk keeps cutting and cutting? Why wouldn't you just wait for a better deal, which is something that we're absolutely watching, and hopefully an analyst will ask Musk about this.
Yeah, that's the big problem with deflation, right? Consumers will just wait until the next price cut and the next and the next and never buy anything.
Exactly.
It's funny that they only grew, 38% in terms of their top line. Speaking of the envy of automakers, like everybody wants that kind of growth. But since we didn't get to 50%, people think that Musk needs to tweak demand. What about GM? What about Volkswagen? These behemoths that are about to unleash just a barrage of competition. How much are they losing on the same kind of EVs that Tesla makes so much money on?
Yeah, so we're at least getting a little bit better sense of that from Ford, right? That just recently adopted a sort of change in the way they're going to report earnings going forward, where they're going to break things down by the sort of old combustion business and the electric business. And the outlook for this year being that they expect to lose $3 billion on the EV side. I think there's probably a good chance that Ford was lowballing there. They're pretty, sage about sort of setting a lower bar for themselves that they can, cross. But it is the case that, Tesla has a huge advantage in terms of the scale at which it's making EVs, and particularly the scale at which it's making the Model 3 and the Y. These two vehicles are doing so much more volume than any other EV in the industry. And so that's the real sort of play here that Musk is making this case of, we can bring costs down, we can afford to take prices down because we're the only ones who are making electric vehicles at this, sort of level of scale.
And Craig, talking about the other companies, the other players in the industry, we got car registrations for Europe this morning, and nearly it showed that the car sales numbers rising nearly the most in 2 years. They've been held back by supply chain issues of late. Now that's going away, but concerns now around supply replaced by concerns around demand. How is that shaping up?
I think what we've been seeing the last few months is there's a lot of pent-up demand here in Europe of people who have put in orders and have been waiting months. In some cases,
lead time's just so long.
Yeah, in some cases more than a year, right? And so what we're seeing is a sort of reflection of what demand has been. And the big question that a lot of executives are going to have a hard time sort of getting their arms around is what the sort of forward outlook is. I think, speaking of this sort of bull-bear debate for Tesla, at the beginning of this week, we've saw analysts covering the European car sector, one talking about an upcycle for Europe and another downgrading their outlook for European car makers. So, there's a lot of uncertainty here. I think, the amount of inflation we're seeing, the rise in interest rates are going to, catch up in all likelihood at some point. The question is when.
Just not seeing it yet. Craig, thank you very much. Remember, it's Craig Judell talking about, the Tesla numbers due out later on today and other car themes. Now, Elon Musk has said the car is one of the least efficient places to put solar energy. As we approach Earth Day, we're taking a look at the solar car of the future.
Are solar cars the next EV evolution? Decades of work on a solar car moonshot is slowing, ceding to a more pragmatic approach. Smaller, lighter, cheaper systems built to subtly augment electric driving rather than power a road trip in full. The sun is hard to ignore as it never stops showing up. And with the market now rife with electric vehicles, there is an auto ecosystem increasingly wired for electrons, including a charging infrastructure that on car solar systems would no longer have to do all the heavy lifting. As far as cost, solar panels have steadily become both cheaper and more efficient. Over the past decade, the price of solar modules per watt of power produced plunged by 78%. To roughly 24 cents per watt, according to Bloomberg NEF. At that rate, a panel array the size of a sedan has dropped from $222 to just under $50. Currently, Toyota sells a solar roof as an option on its Prius hybrid. At Hyundai, meanwhile, a solar roof option is available for its Sonata sedan, and the company is drawing up plans to add solar panels to the Ioniq 5, its breakout EV. And what about Tesla? Elon Musk has stated he believes the car is one of the least efficient places to put solar. That said, Tesla is pursuing an option for its Cybertruck owners to add solar, integrated into the cover of the pickup bed and possibly as unfolding wings.
All right, I would say the key word there is moonshot. It doesn't seem likely that solar is going to be powering our cars, with direct panels anytime in the near future. On the other hand, 15 miles is nothing to sneeze at. So if that's true, I get why you'd put them on.
Plenty of people put solar panels on houses and they don't power the whole house, but they just kind of take the edge off the costs, don't they? Maybe there's something similar. Might happen in parts of the vehicle space. Right, coming up on the program, we'll run you through the major events that we're looking ahead to for the rest of the day, including the bank earnings story. This is Bloomberg.
Our conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now let's take a look at some of the things that lie ahead for us today. Earnings season continues, of course, at 7:30 a.m. Eastern Time. It'll be Morgan Stanley's turn to report numbers. The focus on equities rather than fixed income, perhaps, in that narrative. L'Oreal set to release first quarter sales growth after the European close. At 2 p.m., the Fed releases its Beige Book. Really interesting, even to those, it seems, who maybe don't pay attention to the Beige Book very often, with lending conditions front and center. Maybe it'll be less beige. Tesla reports earnings after the US market closed. We just discussed what was in focus there with our colleague Craig Trudell. And Matt, we need to focus on FX markets. We've seen a bit of a turnaround in the dollar, and interesting lines coming out of the BOJ, we've seen some weakness in the Japanese currency. The BOJ is said to be wary of tweaking its yield curve control policy in April. There's a red headline coming from our reporters over in Tokyo, according to people familiar with the matter. So the BOJ said to be wary of tweaking yield curve control because of the banking crisis, it seems.
Yeah, you can imagine that would cause some traders to turn around carry trades. On the other hand, I can imagine you'd be wary of such a serious policy move. So that makes perfect sense. Nonetheless, we've seen the dollar really gain ground, not only against the yen, but also against the pound. Remember, the dollar was weaker against the pound just about a half hour ago, 50 minutes ago. And now it looks like the Bloomberg Dollar Index continues to rise. Yesterday at this time, we were at 1223 on the Bloomberg Dollar Index. Now we're right up against 1229, so some pretty decent gains in 24 hours.
Yeah, interesting to think about where we are on the BOJ conversation. I keep reminding myself, though, that as we heard from Governor Ueda some time back, there is always an element of surprise, which he seems fully aware of when it comes to central bank policy. So we'll obviously follow that BOJ story as it evolves. On the dollar, then, here we have euro dollar for you. The pound, as Matt says, the pound back down 0.1%. It got up as high as 124.7 a little earlier on. So we did see some fairly solid gains for the pound on that strong inflation print, stronger than 10%, double digits, still the reality for inflation in the UK. That is it for the early edition. Surveillance is ahead. Tom, John and Lisa will take you through all the latest market moves. They will also continue our coverage from Ireland. Ryanair's CEO Michael O'Leary will be joining the team from Wicklow in Ireland for that Bloomberg event. This is Bloomberg.
talk to us maybe about like how important data targeting or targeting of an audience actually is? Because I think we hear these things like, oh, it makes it harder for advertisers if they're not able to track your data. Why is that so important? And like, can you maybe give us some numbers around how valuable a targeted ad is versus an untargeted one? I don't even know if untargeted ads exist on the internet.
Oh yeah. Well, and just on to sort of add on to Tracy's question, like let's say I go to golf.com.
Yeah.
Okay. The ads that I get, like how much is it? Oh, he's on golf.com. He probably wants to read about golf, as opposed to ads that I get that maybe, you know, the last 10 sites I went to is like pets.com or something like that.
Yeah.
And so how valuable is it for golf.com to be able to know that I also like pets?
I mean, there's all sorts of open and unsolved questions about the value and precision of online advertising. The classic example is like you go and you buy a pair of sneakers and then all you see are ads for the same exact sneakers, like just following you around the internet, right? It's like, I just bought these. Why do you, like the world's biggest tech companies that so supposedly know a lot about you, like can't solve that
You bought one pair of sneakers, you must want
might want
more.
another one, right?
Well, I do, but I definitely don't need a second stone.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
It has been a very thin rally. There are certain parts of the market that are doing well, others that continue to struggle.
It's remarkable the way that the economy has performed in the face of such rapid increases.
The consumer balance sheet overall is in good shape. Business balance sheet overall is in good shape.
There is still a lot of residual tension related to liquidity within the banking system.
You're in a transition period. We had 14 years of low interest rates, and the real impact on valuations, it takes a while to filter through.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures negative 0.6% on the S&P. Wrapping up bank earnings for the major players on Wall Street a little bit later this morning with Morgan Stanley in the next couple of hours. After the close, though, yesterday, a focus on the regionals. So let's focus on the regionals right now. Western Alliance in the pre-market up by 16% this morning. Zion's a little bit later after the close, then on to First Republic this coming Monday. Now, TK, we've got to talk about this. So far, so good for the regionals. Never mind the big players. Western Alliance yesterday reporting profit better than expected and deposits recovering slowly.
The Synchrony Financial out moments ago with the same thing, John, leading with deposit information. I'm with you. It's a big deal, and you see it in the market this morning. We don't need to do the data check right now, but this is under the radar within the news zeitgeist. I agree with you. This is good news, calming news by the regional banks, and you see it cross-asset on the Bloomberg screen.
Lisa, Piper Sandler calling this one a significant win for this bank.
They had deposits down about 11%, but the stabilization, the growth over the past week or so, highlighting how perhaps the worst is over. Now goes the question of, okay, is the crisis over? Can we say that we've moved on? And if we've moved on, this goes back to the question you've been asking for the past couple of weeks. When do we go back to pre-March 8th conditions? We are almost there, but not in the bond market. We still have quite a ways to go.
To me, it's about a Fed that gets permission to come up 25 beeps. And again, you see that within the real rate. We'll go into the day, the two-year yield clearly indicative of that, John.
Then what? So you get the hike implied by the dot plot, then what? So they were asking the question whether the banking stress of the last month was a substitute for rate hikes. They concluded to some extent it was going to be. We just didn't know to what extent. We're going to find out. Your two-year this morning by 7 or 8 basis points to 427. Tom, I think there are two ways of looking at this. One, the stress is stabilizing. Maybe even the coast is clear. That's the super optimistic, constructive way of looking at things right now. The other way is this is the beginning of a process. Jim Zouter of Apollo talked about that will ultimately lead to tighter lending standards, tighter financial conditions, and remove some of the pressure from the Federal Reserve to do even more. And you've got to pick your poison. But ultimately, this bond market has repriced as we've shifted away from the worst case scenarios. And we've taken a 2-year from 350 something back towards 430.
Yeah, the breakout this morning at 4.27, a solid 7 basis point move, indicates that direction. You know, that one view there is on the edge of Bramo. And the answer is, Lisa, you mentioned this yesterday, there's a set of narratives out there now. It's not this or that, bull or bear. There's a whole wide set of stories out there. You can pick your story this morning.
I would pick the story of inflation. It's still a real problem. And I know that Britain is its own story, but the fact that it came in above expectations at a time when you see credit tensions easing in some of the biggest risk factors, the idea that something broke, well, maybe it didn't break. Okay, well, then do we have to go back to worrying about inflation again? Starts to really dominate the narrative in a way that perhaps people had forgotten about for a bit.
Double-digit CPI in the UK, sticky inflation over in Europe as well. The Eurozone has its own problems. A story crossing the Bloomberg in the last 10 minutes or so. Bit of breaking news on the Bank of Japan from the team here at Bloomberg. BOJ officials are wary of tweaking or scrapping their yield curve control at a policy meeting next week, so soon after the banking crisis overseas clouded the outlook. This according to people familiar with the matter, Tom, off the back of our reporting. Off the back of that, dollar yen coming back just a little bit. Still positive on the session by 0.5%. Dollar yen, Tom, 134.82.
Weaker yen, 132, 133, 134. First thing I did this morning was triangulate euro yen, and it's really buttressed right up against resistance, where a 148 or a 149 print would be a huge deal for euro yen. 147.38, and that's not so much euro dynamic as yen dynamic, and that comes just before that YCC headline.
Let's get you to the price action just briefly. The S&P 500 futures negative by 0.6% on the S&P. Yields higher by 4 basis points. Let's call it 362 on a 10-year. And in the FX market, just a touch of dollar strength here. Euro dollar, Lisa, back down to 109.33. We're negative there, 0.33%.
The main course today, as you were talking about earlier, bank earnings. Do we care about Morgan Stanley coming out around 7:30 a.m.? Or is it really going to be the focus on Citizens Financial, U.S. Bancorp? We're going to get all of those in the next couple of minutes here in the 6 a.m. hour. We get Signature Bank and Silvergate Capital at some point today, and then Zions Bancorp after the market. You pointed to what we got yesterday, given that Western Alliance performed much better than expected, the huge pop. If we get a consistent stream of that from the regionals, all of a sudden, is banking crisis over, and do we revert back to where we were before? At 2 p.m., we get the Fed beige book. I know that, Tom, you're going to be reading through the whole thing. I actually think this is going to be really telling at a time when you do see that Bloomberg U.S. Financial Conditions Index revert back to almost where it was before March 8th. Do we get a sense of the bifurcated nature of places like San Francisco versus, you know, somewhere in the Midwest or a manufacturing hub in the South? And today, FedSpeak includes both polls of the Hawks and the Doves. Chicago Fed President Austin Goolsbee, who has emerged as something of a dove, 5:30 p.m., and New York Fed President John Williams at 7 p.m., whether they perhaps signal something in terms of a policy response.
Does a beige book get in the way of Bayern Munich, Manchester City? I think it does.
Not for me. Not for me.
I think it's, you know.
It might do for Lisa.
I can look into that.
A little bit later.
Definitely.
I'll say this about Goolsbee, just briefly. Fantastic speech last week, really interesting. Not because of what he said, just because of how he said it. I thought it was direct and easy to understand. He's talking about patience at the moment. I just wonder if that's reflected by him today, Tom, off the back of some of the data we've had. They've got time, ultimately, still early May, just to get a little bit more information from the regionals and gauge where we are.
I just love the idea, and this comes back to 1907 and the formation of the Fed and the modernization of the Fed in 1951. All these presidents are different. And Goolsbee, I love the distance from Chicago to Cleveland, from Goolsbee to Mester. We are so fortunate to have those two within the banking system.
Agreed. George Concalves joins us now to discuss, the head of US macro strategy at MUFG. George, I've asked this question a number of times, but I think we need to update the answer to it. When you look at the totality of the data, the traditional indicators, the latest on the banking situation, where do you think the Fed's going to come out on that?
I think they're going to be relieved that things have not gotten worse. I mean, their measures, as well as just the passage of time, has allowed for us to get a better sense of where we are in this process. But as you described in the open, I'm actually much more in the latter camp, in the sense that it's too soon to tell exactly if this is all done. I mean, we're seeing better earnings, and that's great to see, but this is going to be a process, I believe.
George, I'm fascinated by, and you've always done this over the years, a more holistic view. If we get through these various worries, and with all that cash that's out there, Is there a shortage of bills, notes, and bonds that will move price up and yield lower than we would guess?
At some point, absolutely. I do think that's always been the case. A shortage of collateral has been a big driver of just the nature of the banking system, both the U.S. and globally. But before we get there, we're going to have to get through the debt ceiling, which throws a whole other monkey wrench into the situation.
Do you feel like at this point, George, if the Fed does hike another 25 basis points and holds it there, as they keep saying, even though the market disagrees, that more things will break in a way that people perhaps are not anticipating?
Here's the thing. I mean, the Fed obviously can raise short rates to whatever level they want to get to, but the more they raise rates, then they're going to have to defend that position and stay on hold for even longer. So the more they hike, they're going to have to try to at least maintain their position, because why cut 2 months, 3 months later, right? So I think it does cause a challenge for them, because I do think the data will get weaker into the summer and into the fall, and so they're going to be faced with defending why they raised to begin with these last few hikes, as well as staying on hold at 5+%, which could then start to expose further weaknesses. Like, we got to remember, like, what got us into this issue to begin with was higher rates. The longer you keep them there, it's going to expose other fragilities.
This is the reason why perhaps central bankers are really concerned about the potential banking crisis, whereas certain aspects of the markets have moved on. How much has it been fully priced out of the market that there is some sort of banking crisis or credit crunch that could come down the pike?
Look, I mean, I think the way you put it was, there's a bifurcation among a lot of different measures, both between the financial economy versus the real economy, which the real economy is much more aligned with these regional banks and small businesses, and they're expressing concern about getting access to credit. So the fact that you're having that, and we've had tightening standards all throughout this period, I think it's, again, too soon to tell where we are in this stage. But I do believe the markets are also sending mixed signals as well. I mean, you still have the overall Treasury curve well under Fed funds, so the bond market does not believe the Fed's ability to keep rates high.
Yields have backed up in the last week or so, George. We have repriced the front end of the curve. Do you still retain a bias towards lower yields in the Treasury market at the moment?
We're coming up to some very interesting levels. Somewhere, the 10-year now between 360 and 370. The 2-year note, now meaningfully above 4%. I think if we made a move above 430, 440, I think that's going to be the real true sign if there's demand there. And if we rally right back, then I think that the markets are telling us that we've probably seen the highs in rates, at least on the yield curve.
Yields backing up this morning. George, thanks for jumping in, as always. George Concalves there of MUFG. Yields backing up by 8 basis points, just south of 430 on a 2-year. On a 10-year yield this morning, up by 5 basis points, in and around 363. I think that's the decision we've all sort of got to make. A range of scenarios here. One was the banking situation of the last month, an event we can leave in the past. Or two, was it the beginning of a process, Lisa, that will continue and we'll have to keep an eye on over the coming months and quarters?
It seems like people believe it's a process. How to play that out through markets, though, is different depending on the person as well. I was struck by what BlackRock had to say about the 60-40 portfolio, BlackRock Investment Institute, and the team over there, basically saying it's not going to work and you have to be much more stock-specific. This isn't a market set up for stock-specific type of investing. We have gotten completely obsessed with indexing and sort of broad themes and the beta of what's going on with the Fed. How do you transition to something more old-fashioned?
We can talk about single names, job cuts, Tom, coming to Meta, to the Walt Disney Company.
Yeah.
Another price cut from Tesla on one specific model. Another one. I think that's the second one in like the last month or something.
I don't get
TK.
that.
That's a
It's
struggle
just
to keep
brand
up with.
my amateur take is it's good morning, Mr. Musk. I know you watch all the time. You do it repeatedly. It's called brand destruction.
Do you really think so? Why?
In the minds of the look, every business, the Bloomberg Terminal folks, is built on this, is the repeat purchaser. Every Tesla is a repeat purchase, and you're telling them the car they bought, they got screwed on, and it's priced less now. That's a core part of that equation.
Tesla negative right now by around about 2.5%. We'll pick up on that story a little bit later. Live from New York City this morning. Good morning to you all. Equity futures a bit softer here to kick off today. In about an hour or so, we'll get numbers from Morgan Stanley to wrap up the big banks on Wall Street. Then again later, the focus turns to the regionals. Equity futures down 0.6%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Republicans will vote next week on a bill to raise the debt limit and impose new cuts to government spending. President Biden and other Democratic leaders are refusing to offer any concessions. Republicans are betting that if the House passes a bill, that can ramp up pressure on Democrats to consider compromises. The debt ceiling has to be raised or the U.S. runs a risk of a default. Another strong inflation reading is raising the likelihood for more interest rate hikes at the Bank of England. Britain's Consumer Prices Index rose 10.1% in March from a year ago, driven by the strongest increase in food prices in more than 4 decades. The pound edged higher and UK government bonds sank after that report. Senior Russian officials have raised concerns that the war in Ukraine has left Moscow too reliant on Chinese technology. That's after U.S. and EU sanctions shut off access to alternative suppliers. An internal Russian memo suggests that Moscow is concerned that Chinese technology may pose a risk to Russia's information security. Fox News has avoided a potentially embarrassing trial. The network agreed to pay $787.5 million to settle a voting machine maker's defamation lawsuit over its 2020 election broadcasts. The settlement was less than half what Dominion had asked for, but was far above some analyst estimates. Fox had aired bogus claims that Dominion rigged the vote against Donald Trump. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
The digital world has really changed the banking market. We're in an evolving market in the States. What was a deposit liquidity crisis is now a evolution of their business model, and really it's going to be a period of tougher financial conditions.
Jim, I got to make some news this morning. I'm looking for a Western Alliance transaction. Would you like to break that news here this morning?
I'll let others talk about that one. I got my hands full.
The brilliant Jim Zauter there joining us yesterday, the co-president at Apollo Asset Management, live from New York City this morning. Good morning to you all and welcome to the program. A little bit later this morning, earnings from Morgan Stanley. Got to reflect on some of the regionals so far. We mentioned just there Western Alliance. In the pre-market, that stock is up by about 15%. I'm going to whip through some of the price action more broadly for you on the S&P 500. Futures a little softer to kick off today. To kickstart today, we're down about 0.6%. Yields are bleeding higher again by 5 or 6 basis points on a 10-year to 363.29, and on a 2-year up 8 or 9 basis points, just short of 430. But that repricing is real on a 2-year. We're repricing yields higher.
I agree. It's a big move, John, and it's not something to look away from, with inversion from 60 basis points out to 65 and the real yield, which we've hardly talked about, out to a 133. These is, it's a boring Wednesday. No, it's not. There's actually a lot going on.
Just to describe the journey, the 2-year, March 8th, Lisa mentioned that date a little bit earlier on in the last 20 minutes or so. March 8th, the day before SVB started to blow up, the day after Chairman Powell opened the door potentially to a 50 basis point rate hike, the 2-year north of 5%, dropped to about 350 towards the end of March. And Tom, it's repriced from there back towards about 430. I just wonder how much weight we put on the traditional economic indicators again, away from some of the banking stress of the last month. But to Jim Zauter's point, I keep returning back to that question. One-off event we can leave in the past, or the beginning of a process? Jim Zauter talks about the latter, the financial conditions to tighten still to come, Tom.
Yeah, you see it on the screen again, and our guest here right now is going to say the same thing, that you're seeing financial conditions tighten. We keep score of what people do, and a major theme for Charles Peabody of Portales Partners many years ago was get out of the way, the banks will survive, and they will have ample use of cash to raise dividends, buy back shares. And we still see what he predicted in the advance of the banks out of the crisis of 2008, 2009. Joining us this morning, Charles Peabody of Portales Partners. Charles, what I love is your price to book value relative valuation study. And what you're saying is Morgan Stanley, are they out today, John? Help me, I forget.
A little bit later this morning,
Morgan Stanley out today. and the others, and maybe those fancy banks will come into a price to book closer to the more traditional banks. When are we going to see that?
Well, good morning. Thank you for having me. I think the next 12 to 24 months is going to test the franchise of Morgan Stanley as it's been transformed. And before I get going on that, let me just say, kudos to James Gorman. He's done a magnificent job of transforming this franchise and adding ballast with the development of the wealth management and asset management businesses. But so far, this franchise has not been tested in a down cycle. And I think that's what you're going to see over the next 12 to 24 months. And right now, the stock is being priced as if a 20% ROTCE is sustainable. And I just don't think that's going to be the case over the next 12 months.
Within that caution, Charles, what is your single best buy right now within the major banks?
Citigroup, by far. I think it's going to prove to be contracyclical in terms of the stock price. And I think you're going to get a re-rating upwards in that big discount to tangible book over the next 12 months as they show that the integrity of their balance sheet is real.
Charles, we're talking about some of the biggest banks and how much more profitable they can be. We're not talking about the potential viability of regional banks, especially given the new model with a 5% rate on cash, which really changes the math in terms of what it will take for them to turn profits. Do you think that so far we have learned that that model is not dead, disproving some of the naysayers?
Well, I think time will show actually it is a problem. And we've got a mini S&L crisis going on in the middle of balance sheets here in the United States. Tom will remember the old Bank America, the West Coast Bank America that was owned by, started by A.P. Giannini, that has the banker's marble heart out in front of its headquarters building. That bank back in the 80s was an S&L, had an S&L in the middle of its balance sheet and was a zombie bank. We're going to see that same thing repeated again and again. And to some extent, Morgan Stanley faces that same headwind.
We're looking right now at some regional banks that are continuing to report. Citizens Financial just came out with underlying earnings per share in the first quarter slightly missing at $1.10 versus the estimate of $1.13. Which banks of the regionals are you watching most closely to really understand the viability of this model?
Well, it's not technically a regional, but Bank America has, again, the new Bank America, not the old West Coast Bank America, has a S&L, underwater S&L in the middle of its balance sheet. It's got, investment securities that have a $99 billion unrealized loss in the held-to-maturity portfolio. And then it's got, $290 billion of residential mortgages. All of those are yielding less than, 3%. And yet their cost of funds, if rates continue to remain higher for longer, which is what Jamie Dimon is worrying about, the cost of funds are going to continue to creep up. So I think it's more of a 2024 problem than it is a short-term problem. In fact, we've been expecting a 20-30% rally in some of these banks into May.
Charles, you know, you and I have been doing this since the Wells Fargo Pony Express was going across the tundra. And the answer is you and I know the short solution is layoffs. And we're seeing some rationalizations of headcount here in this earnings season. Do you predict over the next quarter, 1, 2, 3, 4 into 2024 that these banks are going to radically right-size headcount?
Yeah, and you're already seeing. I mean, yesterday we saw it in the numbers at Goldman Sachs and at Bank of America. So it's going to be business by business. One of the businesses that I think that there needs to be further rationalization is the capital markets, because I just don't see that business coming back this year.
Charles, thanks for that. Morgan Stanley in Focus a little bit later on this morning in the next hour. Charles Peabody there of Portales Partners. I want to pick up on Citizen Financial. Lisa mentioned the earnings out just moments ago. First quarter EPS in at $1, the estimate about 113. A little bit more detail here now for you. Total deposits, $172.19 billion, a touch lighter than the estimate of $180.68 billion. A bit more guidance and clarity on deposits from Citizens Financial. Deposits broadly stable through the month of March. Tom, I'm looking at credit provisions a little bit higher than anticipated, deposits a little bit softer, lighter, lower than anticipated, but the guidance deposits broadly stable over the month of March.
This is Citizens Financial, Providence, Rhode Island. Full disclosure, I interviewed once. The coffee was terrible. And, the bottom line is these banks, he's trading at 0.70 book, price to book. It's got a total return last 10 years now, 7% with a crater that we've had off this mini crisis we're in right now. And my question is, given I've never heard Charles that gloomy, when do the roll-ups start? When do the combinations, these guys just call up each other and go, the regionals go, let's get together and get some scale? When?
I've got to find out what's under the hood first, and we're trying to work that out right now. That stock, Citizen Financial, is down a little more than 6%. It's going to be a big week for some of the regional players. I think we've all got the same question now, Tom. Did you turn down the job because of the bad coffee?
Yeah, it was a bad coffee.
It was the bad coffee.
It was foreign exchange, and they were really polite. I loved it. They all had Bloombergs. It was great, lit up like a candle. And, it's a great bank. And again, it's this regional and super regional. I don't know where they fit into that anymore, but it's these regional banks below the 4 banks we talk, 24/7 about. There's a real mystery. Where are they Lisa, where are they in 3 years?
I mean, that's what Charles Peabody was saying, that basically they could rally 20 to 30% in the next couple of months because they're going to avert the pain. And then, wham, we're going to see the effects of longer-term math that does not make the position that they were in viable, that they were in for decades with 0% rates. And I think that's ultimately a question we're not going to get an answer to. So you just keep dancing until you get a right answer and say, well, we can make some money.
Well, the equity market's been dancing. Futures are down this morning by 0.6%. Great lineup for you. Fantastic lineup of conversations just around the corner, including this one with Lizanne Saunders, the Chief Investment Strategist at Charles Schwab. A little bit later this hour, we'll catch up with the Ryanair CEO, Michael O'Leary. Looking forward to doing that with you a little bit later. Yields are higher by 5 basis points on a 10-year. Let's call it 363.
Did you ever fly Ryanair where you had to stand up for the trip?
No, you sit down.
You sit down?
Very tightly packed. On a 2-year, yields higher by 7 or 8 basis points at 4.27 from a beautiful New York City this morning. Good morning.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
From New York City, welcome to the program. Here's a flavor of the price action this Wednesday morning. I think it's Wednesday. It's a Wednesday?
It's Wednesday.
It's Wednesday.
It's
Thank you very much.
Wednesday.
Appreciate that.
You're not alone.
I told you, whenever we used to start the radio show together, Tom, I used to write down what day it was because it was so early. I'd always forget. Futures right now up 5 or 6/10 of 1% on the S&P. On the NASDAQ up by 8/10, or rather down by 8/10 of 1%. It's a softer session. We're negative across the board here. Just to repeat that, the S&P down by 0.5 of 1%. This is not a good start. In the bond market, 2s, 10s and 30s shaping up as follows. I'll get the direction right for you now. Yields higher by 7 basis points. Bottle this, TK. This is the best of 23. The 2-year right now, 4.2713. Yields repricing higher as we start to fade some banking stress again.
Yes.
Off the back of the latest earnings, Tom.
This is a Bullard market, and where people are reassessing where James Bullard is, which is, you know what? He's got a constructive GDP view. He's got a constructive view on we got to fight inflation. So the market resets away from the remedial effects of a banking crisis that may not come because maybe there isn't a banking crisis.
Morgan Stanley in the next hour. Let's talk about a couple of currency pairs and start with euro dollar. Inflation looking sticky in the Eurozone, 109.35 on the euro. Negative here by 1/3 of 1%. Inflation sticky in the Eurozone. In the UK, double-digit CPI still above 10%. Quick word on dollar yen and the BOJ. Our latest reporting on the Bank of Japan from the team here at Bloomberg. I'll read you the lead paragraph. The full story, of course, available on Bloomberg.com and on the Bloomberg terminal. Bank of Japan officials are wary of tweaking or scrapping their yield curve control stimulus at the next policy meeting. This according to people familiar with the matter. Not a big move in dollar yen off the back of this story, I have to say. 134.82 on that currency pair, Tom. Still positive there by about 0.5 of 1%. Some dollar strength out there through G10 this morning.
The dollar strength there in euro yen does not confirm a yen move today. We're still within the trading band that we've seen. This is a great joy for those looking at the many narratives of the market. Liz Ann Saunders has written those narratives for years at Charles Schwab. There's no question, John, about it. I know you've got what she's been writing about recently, and I'm sorry, this is a good time to talk to Liz Ann Saunders.
Well, just to quote some of Liz Ann's work, here is the quote on the Federal Reserve. Given the Fed's strong desire to not repeat mistakes of the 60s, the 70s, we think parts of the market have grown too optimistic in pricing and rate cuts. Any quick pivot, Tom, to rate cuts would likely only occur in the face of more dire economic, labor market developments and/or a significant worsening of banking system strains.
When I go there with John is economic developments. I love how Ms. Saunders goes back to 60s and 70s. I mean, that's a perspective.
It's the fear of this committee.
Yeah, I think that we've all got our memories here, and maybe those memories are just that, memories and not the clear and present. Liz Ann Saunders joins us now with Charles Schwab. Liz Ann, the clear and present for you is factor analysis. My problem is maybe I've got 5 ideas or 10 ideas. Torsten Slok over at Apollo says maybe there's 20 ideas. How do you find the 21st security to own? I mean, it's just really difficult out there to do stock selection towards quality and positive free cash flow.
Well, interestingly, the last couple of weeks, you have seen a more definitive bias from a factor perspective toward, and this may seem obvious, but it's finally working its way into factors, is interest coverage. So and by the way, second to that would be strength of profit margins. So I think this is really a story of who can maintain profit margins in a declining, nominal inflation environment, which had been a real support for pricing power. Now we're going to have to see who's actually got the pricing power and who can cover that interest. But as we've always said, you can apply factor-based screening across the spectrum of markets. Too many people think, all right, you have to start with a sector or two and then apply screening within. You can find value characteristics or factors within stocks and areas that might be perceived as just in the growth area.
What you just heard there, folks, bottle. This is off of Tushar Shande of the Massachusetts Institute of Technology. 1,000,000 years ago, I can't say enough about the need to go cross-sector in analysis within sector. This is gospel for me and Lizanne. Okay, Lizanne, I've gone cross-sectors. Let's go type 2 negative. What do I want to avoid?
I think you want to avoid, to some degree, the opposite. You want to avoid the companies that are not self-funding, the zombie companies that don't have the EBITDA to cover interest expense, that can only fund their operations on the back of additional leverage. We had, I think, close to 30% of the Russell 2000 at one point last year could be classified as zombie or pretty close to zombie companies. So I would certainly avoid those. And you do get a lift like we saw in January down the quality spectrum in the non-profitable area. But I think this is decidedly a place where you want to focus on what's dear, positive earnings revisions, the interest coverage, strength of balance sheet, high cash, low debt. The opposite represents where you want to avoid.
Right now, is the pain trade just higher, even among some of these zombies at a time where a lot of people point to stimulus that hasn't been fully worked out of the system yet?
I think the pain trade probably is still a bit higher if you look at institutional speculators. Recently, they did hit a pretty extreme short position in the S&P 500. That, by the way, hasn't always been a contrarian indicator. Sometimes they're sort of dead on, as was the case in September of 2007. But I do think some of the short-term rallies that we've seen in this market, particularly concentrated in January, did represent a lot of short covering and the pain associated with that. So there is still a decent amount of bearish positioning, and that could provide some support for the market. But I also think the market has recently gotten a little bit overbought, not to mention the fact that we've reverted back, short-term anyway, to a negative correlation between bond yields and stock prices. So this recent move up in bond yields has been met, certainly on a day like today, with a little bit more weakness in the equity market. And I think that negative correlation is likely to persist, maybe even in a secular way.
Wait, this is important, Lizanne, because a lot of people are wondering, okay, can we go back to 60-40? BlackRock Investment Institute said, please don't, not yet, it isn't time. And what you just pointed to, what you just said in terms of a secular change would suggest you agree.
So from the 60s to 90s, kind of mid to late 60s to the mid to late 90s, you almost the entire period on a rolling 120-day basis had a negative correlation between bond yields and stock prices, because that was an era of more inflation volatility. So often when yields were going up, it was reflecting inflation having been let out of the bag again, negative for the equity market. Then fast forward to the Great Moderation era, as coined by Larry Summers, basically the 20-plus years heading into the pandemic. Almost that entire period, save for a brief period in 2008, you had a positive correlation, because even during that era, when yields were going up, it was typically not reflecting an inflation problem, but stronger growth, positive for the equity market. I think we're going back to that environment like the 30 years prior to the Great Moderation, which is more inflation volatility. That is not the same thing as saying inflation is going to stay high in a secular way, but just more volatility and inflation. And for the newbies out there who haven't been around as long as I have, it's just a different investing backdrop. It's not necessarily significantly worse. It's just different relative to the era of the Great Moderation.
The era we're in, Lizanne, and Schwab is a guilty victim of this, is selling us on index funds. And we're all indexed up to our eyeballs, and we're particularly indexed up to broad indexes. Are we over-indexed, and do we have to go more specific, narrow index, or dare I say even individual stock selection?
So we've always espoused the benefit of having both passive strategies within a portfolio and active strategies. And as you all know, last year was a year where active had its best year relative to benchmarks since 2005. And I do think in general that the playing field is getting more level, that active has the ability to operate relative to passive in a beneficial way, unlike what we have seen in the recent decade or two. And I think in part that has to do with the return of the risk-free rate, the fact that when you had rates at zero and negative in other parts of the world, it kind of mucked with price discovery and capital misallocation. And I think we are reconnecting fundamentals to prices. And I think that price discovery that is allowed by the return of the risk-free rate, I think, is to the benefit of active. That does not mean sell all your passive funds and become a stock picker. I think there's still a home for both, but I think active managers are just operating on a better field right now in terms of being able to outperform benchmarks.
Lizanne, a clinic from you, as always. Thanks for being with us this morning. Lizanne Saunders there of Charles Schwab on this equity market. On single names, I want to pick back up with Citizens just briefly. I don't know if Mohammed Al-Arian works on the board of Citizens, but here's the headline. What happened in March was not a regional banking crisis. Another name, another voice suggesting it was not a crisis, this coming from a smaller bank in the United States, saying what happened in March was not a regional bank crisis, and going on to provide a little bit of guidance as well. They now see full-year net interest income at plus 5% to plus 7%. They had seen full-year net interest income at plus 11 to plus 14. So a slight downgrade there, Tom, to the outlook at Citizens.
It's a downgrade, and maybe it has to do with the rate structure, maybe even has to do with the spirit of the economy and all. But, Lizanne brought up the zombie concept, which I've been beating the drums on. I'm not saying these banks are zombies. I'm saying strategically to compete, particularly with the Zelle statistics yesterday from Brian Moynihan, digital banking. How do they compete? I'm not sure how.
I'll pick up on that. I think that you're right. How do you sort of say, okay, you're not, hold on a second. It's not a zombie. It's not a crisis. It's a slow bleed. It's a slow questioning of a business model that is much more challenged when rates are where they are and people are more selective about where they put their deposits. That's the distinction. It is harder to see it in real time. And perhaps that's the reality, as we were talking about yesterday with Jim Zeltner. I mean, to me, that is the issue. This is going to take time, and it isn't necessarily a wholesale collapse.
The start of a process. Keep going back to that phrase, don't we? The start of a process.
A journey.
My friend, maybe even a journey.
It's a journey.
My friend messaged me yesterday evening and talked about Apple and just how easy it was just to transfer cash and let's go, 4%, thank you.
Why wouldn't somebody do that?
Well,
new world.
But this is the heart of the matter, and it's the ease of transfer. This is the digital thing that got Silicon Valley into trouble. I mean, I'm sorry, you can do it off your cell phone, right?
Deposits are still super sticky. I mean, I'm speaking for myself. They're still there, earning zero. You just sort of like, one day.
There was actually, Bank of America said people tend to not move it. So you're not alone. Don't worry.
It's a real thing.
I know.
It's a real thing. Coming up shortly, Michael O'Leary, the Ryanair CEO. Looking forward to that conversation in just a moment. Your equity market is negative to start this Wednesday morning. We're down about 0.6%.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Fox News will pay $787.5 million to avoid what could have been an extremely embarrassing trial. Fox agreed to settle a defamation lawsuit by Dominion Voting Systems over the network's 2020 election broadcasts. Dominion says Fox defamed it by airing claims it rigged the vote. Evidence showed that Fox executives and stars derided the conspiracy theory, even as they promoted it. It's official, India is now the most populous nation in the world. According to the United Nations, India's population is now almost 1.43 billion, edging out China. The increase will put more pressure on India's Prime Minister Narendra Modi's government to create jobs. In Moscow, the defense ministers of Russia and China have promised to expand military cooperation. It's a sign of the strong ties the two countries have sustained since Russia invaded Ukraine last year. And it comes at a time when Beijing has been trying to position itself as a peacemaker in the war. Bloomberg's learned that Disney plans to cut thousands of jobs next week. That includes about 15% of the staff in its entertainment division. In February, Disney said it planned to eliminate 7,000 positions from its workforce of more than 220,000 as part of a cost-cutting move. And hedge fund billionaire Ray Dalio plans to set up a branch of his family office in Abu Dhabi. It's part of his deeper push into the Middle East. The Bridgewater Associates founder has cultivated a close relationship with United Arab Emirates leadership over several decades.